Okay, everybody. Well, welcome back, day 3. So this one, it starts to shift as we do today and tomorrow into you and your slides. So this afternoon, we'll be working on pitch reviews. We'll be going through all the pitch reviews with decks. So you'll have your first draft of decks. And then tomorrow morning, you'll have a legal session, really talking about Flat6's documents, things about incorporation. So if you haven't incorporated yet. And then after lunch, we'll go through more pitch reviews. And you'll get feedback from both Sala and I tomorrow. You may get some feedback from Sala this afternoon as well. So we'll see how that all comes together. But for sure, I'll be on with you to get as much pitch feedback as possible on your deck. One thing on your deck too is as you go through this before you get to Monday is to look to internal resources if you have them, and for designers to make them actually look a little bit better and give some design to it. If you don't have a designer that then Fiverr, is a great example of someplace you can go. Fiverr is a place you can go to get make it look a little bit better. So the point there is that if you have a functional demo or if you have a functional deck, that's great. But if it looks good, you'll get a second shot. So if it looks meh, so if it looks like the plumber did your interior design, the plumbers will like it, but not everybody else will like it. So just plan on spending a little bit of money and getting some design work actually updated and done. So also for those of you who just joined, I did update the slide order in my deck, not in your deck. So I pasted the link to the slides in the chat box, as well as it's in the WhatsApp channel. So because the order of the slides just changed for today. We usually do it in a different order, but because of getting the local team on to talk about pivots here after lunch, we just switched the order around. So please update that. Otherwise, your order will be different. So, all right. So agenda today, we're talking about fundraising fundamentals, investor profiles, how you're going to raise funds, both now and after Flat6. So I've raised money for 5 different companies, raised about $13 million total. Been a VC, so I'll give you both what you need to do, but also what's happening to the VC on the other side at the same time. So because it'll give you context for why you're getting asked some of the questions you're asked and how the process works of the sausage making, if you will, of venture capital. So we'll go through that from a fundraising fundamentals process. After that break, we'll go into your company and product roadmap. So I'm going to spend some time talking about if you haven't built your MVP yet, because some of you haven't done that, how do you do that? And there's a mechanic that I use on Upwork that allow you to build out your specification and then shop that out to a number of outsourced vendors who can build out your MVP. And then after lunch, we'll go into when, why, and how to pivot, and when you should make a decision of, hey, maybe this isn't the right idea, right? Or maybe the timing on this idea isn't right. So how do you go about thinking about a pivot? And kind of, especially if you don't get in the program, part of the reason you're here is that Saul and the team believe in you, but they're like, maybe that's a good idea, maybe it's not a good idea. So what they would encourage you to do is think about when you should make the pivot and do it in such a way that you can live to fight another day, right? So we'll talk more about that after lunch. And then we'll go into pitch reviews. So that's our schedule for today. Okay. Questions on yesterday's deliverables? How are the slides coming together? How are you feeling about the pitches? What's your general? How are you feeling right now?
All right.
One thumb up, some head nods, more coffee. Yeah.
We need to develop it further, definitely.
So, okay.
We already put notes based on the feedback you gave me yesterday.
Mm-hmm.
So we need to update the slides, and hopefully today they'll look better by the end of the day.
Got it. And did you decide to pitch the bigger idea, or did you decide to pitch the jewelry idea?
Basically, the big idea. We want to take the stakeholders in our palm, hopefully.
Okay. Yeah, Samir.
Hi. So after yesterday's sessions, we like had a lot of information to process, and we did our best to update our pitch deck. And we hope today, once we get some, once we actually do like a review together, we can get some actual and concrete feedback on what we should improve on.
Great. Anybody else?
Hello.
Hey,
Good
how are
morning,
you?
Dave.
Good morning.
For me, I couldn't sleep much last night, actually.
I hope it was a good reason or a bad reason. I'm not sure.
Well, I don't know. I couldn't sleep actually. I tried my best to sleep so I could wake up early, but I could not. That's why I'm a bit late now, actually.
That's okay. The good news is you don't have to present this morning. You got till this afternoon. That's why I'm working on
Okay.
coffee.
Okay.
So my schedule is I typically grab a few hours of sleep after I'm done with you guys and then work my regular time as much as possible and grab a nap before I come back. So now it's like, oh, you have to yawn. So, and I see another Starbucks cup there, at least another coffee cup there, which is always good. So yay. So good for coffee. All right. So I'm going to walk you through fundraising fundamentals. So let's talk about how you're going to raise money, the process of raising money, what's going on with the investors, and kind of investor profiles. So I think the big thing here is that what you need is stage appropriate capital. And what I mean by that is that it's the right money at the right time. So from an investor perspective, your early investment of where most of you are right now is accelerators, early stage VCs, and angels. Later stage capital includes the later stage VCs and private equity. So I spent 3 years working at a family office, and I've worked at 2 different funds. One of the funds was a corporate VC fund out of Tokyo called Mitsui and Company. So Mitsui is the 3rd largest company in Japan, like $187 billion in revenue. So their thesis, even though we were a $250 million fund, their thesis was we want to invest in technologies we can help bring to Japan and use Japan as the gateway to get to Asia. So their thesis was it has to be something that could be multinational and has technology advantage about entering new markets. So that was one piece of their view. One of the other funds I worked for was Seven Peaks, was a fund based in Oregon. They were the largest fund, or the most active fund in Oregon, not a super big fund. So their first fund was probably $10 million. Their second fund was $25 million. They originally thought they were going to raise $45 million and ended up only raising 25, and which didn't give them enough capital to really expand into the Seattle area. So Seattle as a market is about twice as big as the Oregon market. So they raised enough capital to continue to be the largest investor in Oregon, but not to really become the largest or a significant investor in Washington. So I left that fund because I was a venture partner. And we'll talk about what the different roles are within a venture fund. And then I worked for a family office for 3 years. And that fund's focus was whatever the investor wanted it to be. So the fund owner, so instead of having multiple limited partners, in the case of a family office, I had one limited partner. So what he was interested in was whatever was interesting to him. So instead of having a fund thesis like Mitsui, where Mitsui was focused on companies they could bring to Japan and then through Japan into the rest of Asia, or Seven Peaks, which was focused on early stage technology on the West Coast, the family office was whatever my investor was interested in. And family offices are a little obscure, right? So like I never talk about who the family office owner is, not because of a non-disclosure necessarily, but because people don't know who he is. So he made all of his money as a hedge fund manager in Chicago, moved to Seattle a number of years ago, probably 15. And then his investment thesis was completely different, right? So what he was interested in was things that were interesting to him. So power, sustainable energy, water, and then any innovation technology, which as a fund manager was super hard, right? Because you're like, I wonder if he'll like this. I wonder if he'll like that. And then some of the investments weren't actually driven by thesis. So some of the things he wanted to invest in, I had to talk him out of, because I'm like, I don't think that's actually a good investment. Right. So it could have been interesting and it could have been innovative. But the question is, could it make money? And in many cases, some of the stuff that we came to, I'm like, you can invest in it because it's your money, but I don't see how it will make money. Right. So the reason I bring it up is the stage of the investment and the profile of the investor is very different. And you have to figure out who they are and what they want to invest in so that you can know whether it's a good use of your time or not. Because many investors, like we were talking about yesterday with Hussein, will take a meeting from you, but it's not necessarily a great use of your time. So what I want you to get good at is understanding, okay, I want to qualify the investor based on the stage, the technology, and the location. Like, do they invest in Bahrain, right? Do they invest in Dubai? So, or Nigeria in one case, right? So knowing the investor profiles is super important. Also, when you start to take outside money, not just the capital table changes, what's called the cap table, but controls also change. Because when you bring in an outside board member, you have another person to get approval from on what you do. So you have to be comfortable with that approval process, excuse me, and also comfortable with the fact that you're no longer just making decisions for you, you're making decisions for all of your shareholders equally. And what's that concept there is called fiduciary duty. So you as a board member and founder have to look at it from the perspective of, is this good for all of my shareholders, the largest shareholder to the smallest shareholder? So the shareholders themselves, not the board members, the shareholders themselves can look out for their own best interest, but you have to look out for the interest of everybody. So that's your fiduciary duty. So as a board member. So also you'll have dilution with every round of funding. So the mechanics for fundraising, let's say Mohammed and I start a company and we're nearly equal partners, right? So I've got, if we have 4 million shares together, he's got 2.25 million shares and I've got 1.75 million shares. When we raise another round of funding, and let's say we raise $1 million at a $4 million pre, so I can keep the math easy, we're going to sell an additional 1 million shares. And that doesn't come out of my shares or Mohammed shares. Those are new shares that are created out of the air that you're now diluting the company. So now I've raised $1 million of money with 1 million new shares, but we've taken a 20% dilution. So instead of us him owning more than 50%, now he owns closer to 35%. So each round of funding is going to have additional dilution. So why do I bring that up? You don't want to spend 8 years working on a project and not getting anything out of it. Yeah. Right? So you can raise more money than you need, but if you do, you take more dilution than you need. And what that means is after 3 or 4 rounds of funding, all of a sudden as a founder, you're down to 7 or 8%. And you've been doing this for 8 or 9 years. And the company sells, and after everybody else gets paid, you get paid last. So you say you sold it for $50 million, all of a sudden you're like, wow, after 7 or 8 years, I probably could have made as much money doing a job, right? So even though you can raise more money, that dilution causes your piece of the pie to get smaller. So that's the idea there is what's called the waterfall or the preference stack. So the idea is each round of funding has a different set of preferences. So in a series, so you have common stock, the first round you'll raise will be preferred stock. So it could be a seed round. The seed round then has an A round and a B round. So when the order of things get paid, the preferred stack works opposite. The B round gets paid first, then the A round, then the C round, and then last is you. So, and that's not necessarily a bad thing as long as there's not a weird preference that says, hey, somebody gets 2x their money before you get paid. So we always, when we're selling a company now, we always look at the preference stack and when the founders actually get paid. So I bring that up so you know in advance, like, okay, I can go raise the money, but there are costs associated with the money that impact what you get and when you go to sell the company.
Dave, are
Yeah.
you going to speak about the votes and the control, or is it beyond the scope of?
Yeah, I'll speak to it a little bit. I think one of the things you need to be aware of at this point, and without going into a ton of detail, is that when you have a board, you vote the board, or each member of the board votes for the shares that they control. So you control the common shares. So if you have with the board more than majority control, more than 51%, then you can control how the board votes, even if the board votes against you. Now, it's seldom that the board's split at the stage of the companies you guys are at. Your board is generally in agreement with what you're trying to do. And it's seldom that I see boards that are split. But what you want to do is know that as you bring on more money, right, then there's more people voting for the direction the company should the company should go. One of the things I wrote about in the book is that when you take on outside venture capital, you also take on their business model. So in addition to the revenue models and business models we talked about yesterday, with a venture capital firm, you take on their business model. The VC's model is typically a 10 1-in-1 model. So they do 10 years plus 2 1-year extensions. So the important thing to know there is that they're out raising money, just like you're out raising money. And the first fund may be a $10 million fund. The second fund may be a $25 million fund. So one of the things they're looking for is at some point, what I have promised my investors is I will create a return for them within 12 years. So if your company's doing great, but I invested in you at the second half of the fund life, and that fund is expiring, and you're at the 5-year mark as an investment, and you need 2 or 3 more years before you really have a great return and want an exit, I'm probably going to push you for an exit earlier. And you're like, that's crazy. Why would you do that? And the answer is, well, I'm at the end of the fund life. And my limited partners, which is the 31 people on this call, are saying, hey, you told me it would be 10 1-in-1, right? We're now at 12 years. I'd like to get my money back. So typically what happens with that is the fund will go into what's called closing escrow. And when you exit the fund or when you exit the company, the escrow gets paid and the investors get paid. But that's why there's such a big market for what's called a secondary market. So I mentioned yesterday my friend's company, DocuSign. DocuSign was a 16-year overnight success. Now, since they went public a little over a year ago, they went public at $32 a share, and their stock went to over $200 a share. So for the people who paid 75 cents a share, it's an awesome stock, right? Now, they had to wait 16 years. So the question is, how awesome was it given the fact that I had to wait 16 years? So know that that's, the outcome is amazing. The challenge is the investors have to be willing to wait. And the right timing isn't, as an investor, I'm not going to come back to you and say, hey, Mohammed, I've had a change. I need to buy a new house. Could you give me some money back? You guys can't do that. There's no liquidity in venture capital, right? It's not like selling a public company stock. So it's just a long time frame is the point of it. So, and then the last point there is just bad boards can equal bad enterprise value, right? So one of the things that I would encourage you to think about is when you take on a new outside board member, when you take on that money, make sure you get somebody with experience and hopefully can add value, as well as really as just adding cash. So to the conversation yesterday, not all money is good money. So that's kind of a quick overview on fundraising. So from your perspective, what are you raising for? In the early days, where you are right now, you're raising for basically 6 months at a time. And you're raising to hit the next milestone. So we want to get our MVP out. We want to get new customers. We want to get a business development deal. We're looking for a partnership and distribution, right? So you're raising just enough money to hit the next milestone. So getting the product out and getting some revenue is a good example. So if you could, you'd be like, I want to raise $1 million now and then not have to raise for 2 years. That's not the way this works. The way it works is you're in the early days, you're raising just enough money to kind of keep the doors open. But once you get into the process and get out of Flat6, one of the things you look at is to start to raise money for an 18-month window. And the idea of that 18-month window is you have capital to deploy for 12 months, and then you have 6 more months to raise the next round of funding. So when I think about a lot of timeframes, and then we talk about product later today, we'll talk about an 18-month time frame. So I'm looking for that for, here are the next 6 quarters. What can we achieve in the next 6 quarters? Right. But in the early days, the classic is when you're later stage funding, you don't want to have less than 6 months of capital because investors could string you along. In the early days, you always have less than 6 months of capital. That's the nature of where you are. Right. So, which typically means you're not getting paid. Right. And I'm a big fan of the fact that founders should at least get a livable wage. So that's kind of an important feature for both you and your family, your life, your significant other who's like, why are you doing this? This is crazy. Right. So you need to find a path for you to get paid as well. So investors aren't against that. Some investors will say it's your commitment and sweat equity into the deal, but in general, we're after you getting a living wage. So, and as you get closer to later stage fundraising, you get closer to market for your salary. So you're raising for 18 months, you're raising to hit milestones, product milestones and customer milestones. You're not raising just to pay myself for 18 months. So when you talk about what's called use of proceeds, the use of proceeds is what are you going to use the capital for? It's not so we have 18 months worth of runway, right? It's so that we can go hit these milestones with the product and get this many customers and this much revenue. So you really need to state it in terms of outcome, not in terms of time. So what do you expect to get done in that amount of time from an outcomes perspective? And that'll end up being in your slide deck. It'll end up being your slide that says use of proceeds. So as an investor, I want to know, like, what are you going to use the money for? Oh, we need to raise $3 million, $170,000, whatever the number is. I want to know what you're going to use it for. Back to the financial model from yesterday, I typically like to see an actual number, not a round number, right? So it's not, oh, it's $2 million. I'm like, 2 million is a pretty round number. Like, is it 1.6? Is it 2.1? Like, so I want to see that you've done the math on the financial model that actually shows how much cash you actually will need. Okay. Okay. So angel investors. So angel investor profiles, angels invest in you and your passion. They like to talk about their investment portfolio. They typically invest in themes that they know. Most investors will seldom invest in areas they don't understand. So when I sold my first company, I made a couple of investments into the pharma and medical business. I don't actually know anything about the pharma and medical business. You can guess how those investments turned out. Not well, right? So I lost my tail in those ones that didn't work. So I tend to invest in things I know. So do I know the market? Can I actually add help to the company? If I can't add value to the company, I typically won't invest. And mostly because it's not because I'm not curious. I'm kind of curious about everything. But what I've learned is my risk profile is tied to, I can actually understand and do due diligence on products I actually know, where products I don't know, I'm like, I don't know how to evaluate them at all. So that's what I would tell you is you want to find out, have they invested in a market like yours before? So, and if they have, great. And if they haven't, you have to educate them on both your market and your product. So at one point I was doing a company that was focused on the China market. So we were helping Western companies find talent in China and launch in China. So I had people who were curious about the company because I was in Seattle and they're like, oh, I hear you're doing business in China. I'd like to know more about the company. What I learned was if they didn't understand the China market, I would either educate them about the market or I would educate them about my company. If I had to educate them about the market, they would not invest in the company. They just didn't know enough. So I had a handful of investors who invested just because it was me and they had made money with me before. And their answer was, we've made money with Dave before, so we're just going to give Dave money. We don't need to understand what he's doing, right? Those are rare because they're investing in you usually because you're a repeat founder. So, so somebody said, what about Singapore as a market? I'm not sure I understand the question.
Well, you were talking about China market, so
Yeah, so I think if you
playing out as well. If you're talking about technology and stuff like that, Singapore market is also another whole different world if you've been to Singapore.
Oh yeah, for sure. And it's kind of the gateway for the Indonesian market, right? Is the way that folks will look at that one too. So I guess the point there is that if you have to train somebody about the market, if that's your primary market focus, which was ours, was helping Western companies launch in China, if we had to train them about it, they wouldn't invest in the company, right? So the big picture takeaway for you is if they don't understand your market, it's not likely that they will invest in your company. So what you want to do is qualify them as you go through the process before you have a meeting and ask them questions like, so have you invested in this type of technology before? Have you invested in this market before? What do you know about the market? Are really your qualifying questions for them as well as their qualifying questions for you, right? So, so typically the deal types in this early stage are going to be either convertible debt or a safe. So, and we're seeing a lot more safes in your guys' market these days, thanks to 500 startups and, and folks like Flat6. The two mechanics there are basically, they're the cheapest way for me to get money into your company. And early stage, you guys don't know what your company is worth, but it's hard to sell equity because you're like, well, in 6 months, the company will be worth 3 times as much as it's worth right now. So rather than sell equity in the company, selling convertible debt or doing a safe is the easiest mechanic. So the mechanic for both a safe and a convertible debt are super similar. So let me walk you through both of them so you understand it. And you'll get this in a legal seminar tomorrow as far as how Flat6 does it. So convertible debt basically says money's going to come in your company as debt rather than a stock purchase. It's going to have a term, which is going to be an interest rate and a payback schedule. And it's going to have a conversion cap. So the idea of the cap is if your company does really well and it takes off and goes up and to the right, then you go out and raise the next round of funding at a 5 million pre-money value. And we'll talk about pre and post money values here in a little bit. If you go out and raise money at a 5 million pre-money value and my cap was at 4 million, then all the cash that I put in converts at the cap of $4 million. So if the cap's $4 million and I gave you, I'm not going to do math in my head off the top of my head, it's too early yet with coffee. But the concept there is if I own a couple percent of the company, then when you go and raise the next round of funding, I'll still own a couple percent. If I put in a small amount of money, $50,000, and you raise money at 8 million and there's no cap, then my 2% became 0.3%, right? So the idea of the cap is your earliest investors know what their price is going to be at the maximum. If you take money in at less than the cap, no worries. I get 3% instead of my 2%. So that's how a cap works. A safe is similar in that I'm actually giving you money, but a safe says I have the right to buy stock at a future date at a future price that's capped as well. So it's similar, but it actually comes into the company with a promise to buy stock at a future date and a future price. Then when you raise money a year from now and you actually sell equity, I get to buy under that price of the price that you put in today. And the reason's simple. I'm putting in the first cash, and with the first cash, it's the highest risk. And you don't know how to price it. I don't know how to price it because I'm an angel investor versus an institutional investor. And we just say, let's just make sure the price doesn't go above this price, and then I'm comfortable with it. So with angel investors, they're typically not a lead investor. You're typically raising kind of as you go. And as long as the terms are reasonable, or what I would call on the pitch, right? Back to our Samir's example of watching the video on the pitch. So if it's on the pitch, it's kind of like, yeah, it sounds about right. So typical early stage deal, maybe we're raising up to $1 million at a $3 million pre-money value. So, and a $4 million post-money value. So what that means is before the next round of funding comes in, we're placing the value of the company at 3. And the maximum value at 4 is the cap. So I know that if I put in $50,000, I'm going to own a certain percentage, right? Now for you at the early stage, you're like, I'm just stringing together a series of checks for $25,000, $50,000, right? Or $35,000 from Flat6 and another angel for $35,000. And that really just buys you, 4 or 6 months of runway to go hit your milestones. from a practical perspective. So convertible note is the cheapest way to do it. The legal fees should be super cheap, probably $5,000 in legal fees. There's a set of open source documents by Cooley Goddard that are called Series Seed docs and Series A convertible note docs. And if your lawyer tries to do custom docs, find a different lawyer, right? They're literally posted on GitHub. So they're open source docs that they can download and use and just fill in the numbers. So that's the basic math on Series C docs and on safe notes. Questions about convertible debt or caps?
Okay,
And it's a whole entire seminar.
can you share the websites later, Dave, in the chat?
Yeah, I'll make sure I post them.
Unfortunately, I used to have a very good website called realdoc.com or something, therealdealdoc.com. But now I don't know, we cannot open it in Bahrain.
Oh, really?
Yeah, therealdealdoc.com. It's a very good website. You have an annual subscription and you have thousands of agreements. But I don't know why we cannot access it now.
Interesting. Yeah, so I'll post that as part of on my site today is the notes on convertible debts and on safes. So I'll add that as well. YC, by the way, Y Combinator came up with the safe notes. And part of the reason they did it, and similarly from a open source perspective, is they wanted to make it cheap for them to put money into a company and not have to reinvent the wheel every time. So what you find with these docs are simply, could you do them yourself? You could, but I would encourage you to get legal input. So make sure that you didn't do something wrong. You know, for me at this point, I can easily do them myself, but I would have my lawyer look at them and make sure that I did them right. So for sure. So I'll make sure that I add those. All right, so that's an angel profile. With an angel, if you give me a term sheet I can write you a check for, and the price is reasonable enough, I'll probably just write you a check, right? I'm not going to try to set the terms of the deal or price the deal, or like for most angels, they're like, this is not, I don't want, of my $50,000 check, I don't want half of it to go to the lawyers, right? I want all of it to go to you. So that's something to think about in terms of the pricing and the type of mechanic I use to get money into the company. And you'll learn more about Flat6's profile for doing that tomorrow. Most accelerators are the same, right? They want to make it super simple to get money into the company. All right, early stage investors are really investing, early stage venture capitalists are investing in risk capital versus growth capital, which is later stage. In the earliest stage, when I'm investing in you with the idea of either this will work or it won't. It's a binary decision, right? As you have numbers and forecastable revenue, like we talked about yesterday, you're shifting from risk capital to growth capital because you're de-risking the investment. So know that that's part of the process as you move up to what's called the capital stack, as you move to more mature investors, is as you get traction and revenue and users, all of those things de-risk the investment and it gets to a different investor pool. But the early stage VCs, they want to know that you have a solid thesis, you have unit economic data, conversion metrics like we talked about yesterday. And if you don't, that's okay. Some of them will still take on the investment because they believe in you, but some of them will want to wait and take on the investment only after they see some actual traction. So that's kind of the way to think about it in terms of what the stage of the investors are. I'll just keep posting these notes on convertible debt and on safes here. So you guys have it for now, but I'll post it up on the site today too. All right, so early stage venture capitalists have a fund, they have limited partners. So, and they have what's called a charter. So there's 30 of us on the call-ish. Let's say I was out raising money and I'm the VC and I've got you all to invest in the fund. What I've told you is I invest in MENA, in early stage companies, in technology. So let's say somebody comes to us and says, we have this amazing medical device. Will I invest in it? Nope. What if it's a great deal? Nope. Because I've told you all that I'm going to invest in early stage technology companies based in MENA. What if the company's based in Australia? Nope. Right? Because I don't want to get sued by my limited partners if I lose your money. It's just kind of a simple process. So, so some funds have very broad thesis. Some funds have very niche thesis. A lot of funds in your guys' region will be focused on a particular country, and they don't cross invest. Even within Flat6's portfolio, there's some within Flat6 that only invest in Lebanon, right? So they can give you access to VCs in other markets, but will the fund invest? Typically not, because they've only invested in a particular country versus a region, and that could be because they have sovereign money or family money or government money. So, but that thesis dictates what they will invest in. You can find that thesis on their website. Sometimes that thesis will include the stage and the type of technologies they like to invest in. Most, like family offices, my example, the fund I ran for 3 years, it really came down to what did Robert like? And if Robert liked it, we'd invest in it. And if Robert didn't like it, we wouldn't invest in it. So sometimes that was hard to give feedback to founders, because they're like, well, tell me more about what you thought about our deal. And the answer is, we just didn't like it, right? Which is hard feedback to give founders, because you're like, Robert didn't like it. So know that you will get that feedback at times, where it's like, and it'll be totally whipsaw-ish at times too, to Hussein's comment yesterday. Somebody will be like, oh, there's something there that's wrong with it. We don't know what it is. And it's like, okay, that sounds completely crazy, but that's the way VCs will work at times. So I also have, in my thesis, I also have a target percentage rate. And I will always have what's called an average check. So each of the VCs will have, like, one of the funds that our average check for 7 Peaks was, our average check was $750,000. For that $750,000, our target percentage was 15%. So let's say you were raising $500,000 total, and you were going to give up 25% for that amount of money. When I look at your deal, it was probably too early for us, right? So because my average check was 750 and we wanted 15%. So I typically want to see you raise $1 million to $1.25 million, where we'd be the lead investor, but you'd syndicate that round. So if you're only raising 250, my answer was, come see me for the next raise of funding, right? And you're like, well, I take $1.5 million, but you don't have enough traction to actually raise $1.5 million. So I have a target percentage, and you can ask them, right, when you talk to them, hey, what's your average check, right? And they'll generally tell you. And what's your target percentage rate? And they'll generally, sometimes they'll tell you, sometimes they won't. But what I found is good VCs like, oh yeah, our average check is this, and our target percentage is that, and we'll help syndicate the deal, and help you raise money as well from other partners. So there's a perspective within VC that we have to go find deals. They won't find us. So there's this perception of it being an elusive deal. So we have to be out working to find the right deal, and we want to find it before somebody else does. At the same time, early stage VCs are always talking to each other. So in Seattle, we have a monthly conference call with the angel groups, and we'll be like, hey, I saw this deal. And people are like, oh yeah, I saw that deal too. Did you like Muhammad? Was he a good guy? Right? Did you think the valuation was right? So at the same time, you all are talking about VCs, the early stage investors are talking about you. So just know that that's why you want to be consistent in your pitch, and not go out and say like, oh, I gave one company a pre-money value and said I was going to raise $1 million. I told another one I was going to raise $2 million. Because they're like, I thought the valuation was odd, or the amount of money they're raising was odd. And then I find out on the call that you were presenting 2 different numbers. And I'm like, that's really interesting. Why is that? You were A/B testing, but the investors are talking to each other. And your guys' region within Bahrain is small, right? There's fewer people in Bahrain than there's in the Seattle market. Strangely enough, you have probably more VCs than we have, but they're all early stage VCs. Like in Seattle, we have one dominant VC who's raised, I think their current round is 300 million. So they see every deal in town, but they've only invested in 40% of the ones that were the blockbusters. So there's this kind of like, yeah, I mean, Madrona saw it, and the irony for me is I've never raised money from Madrona, right? So I've raised money from Silicon Valley, because I was like, I don't know anybody in Madrona, so I'm gonna go to the Valley and do it. So within the venture capital fund, the way the VC will look at it is so what's called a venture power law. So if you think of an XY axis, there's your top decile of investments, my top 10% will return the fund. My second quartile will give me a return. So my top 35% will give me a return. My bottom 65% will be worth 0 or a little bit, right? So that's the concept. There is a power law, right? The first few will return the fund. So it's the opposite of a bell curve, right? It's a power law. So I'm looking for companies in the portfolio that I can invest in that could return the entire fund. So 10x, 20x my investment. Later in the stage, that's why one of the things you'll ask is like, where are you in the fund life for your fund? Later in the stage, they may be like, I'm trying to fill out the portfolio with companies who could give me a 2x or 3x on my return and maybe could do it faster. So in some of your cases where you're doing a copycat, and I look at it like, well, so-and-so is going to buy you guys. Like, that's not a bad thing, but it's that your investment's not going to return my fund, but your investment could give me a nice return in a shorter period of time. So, but if it's a super risky investment and I don't think there's good upside, then I'll just say no, right? And you'll find that you don't get good feedback from investors for that reason. So that's why having traction is so important, right? Is what you're effectively doing is lowering my risk of the investment. So, but that's what I'm looking for as a fund manager is, can this deal return the fund? Funds typically can't take dividends. So one of the things that is a mechanic in standard business that doesn't work in venture capital is I don't actually take my money out until you sell, right? So if you return a dividend or cash on an annual basis, so most VCs don't have a way to actually take that money in. They can only take money in when you sell the company. So there's just not a mechanic there to do it. So I'd rather you take that dividend, reinvest it into the business and grow the business faster. So that's always the push that you'll get from a venture capitalist is how do you grow faster, 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 right? So that's some early notes on VC. So from a later stage capital, that's post product market fit. With later stage capital, there's things like private equity, large scale VC. Those funds are making investment based on cash returns. So they're going to have more MBAs and more spreadsheet jockeys than you've seen. And they're going to calculate in, how much money you're making today. If we gave you $10 million, how much money could you make in 3 years? And they're going to look to sell you to a much bigger private equity firm on average 3 to 4 years later. So that one is not risk capital. That one is totally growth capital. So if you're spending $1,000 on marketing today, could you spend $10,000 on marketing? How would it change the dynamics of the business? How quickly could you grow the business? So private equity and later stage venture capital is really focused on growth capital versus risk capital. To use my same analogy with DocuSign, the last round of funding they did before they went public, they raised $400 million of growth capital. And Tom's comment was, it was the easiest round we ever raised, right? So in the early days, people are like, is this legal? Can you actually do this? Is the technology work? Right. And in the later stage, it was like, how fast can you deploy this capital and how far can you grow with $400 million? And that was the money they took before they went public. So later stage, it's all about the math, right? Earlier stage, it's all about the risk. So just know those are the difference in profiles. So typically later stage is going to look for controlling interest if it's private equity. And they don't necessarily need 51%, but they may have control as it relates to board votes or controls from a legal perspective and terms. But typically they're looking for at least greater than 20% of the company. It could be 51% of the company. In some cases, they're effectively buying the company and giving the founders some money and then giving you a second bite of the apple when they sell again 3 years from now. So that's typical of a deal structure for later stage. Why do I bring it up now? If you talk to a later stage VC, they'll likely take your meeting if you're doing something interesting. Are they going to write you a check at the stage you're at? Nope. Right. But you'll walk away from the meeting feeling like the meeting was really good because they were attentive and they were listening and they were talking about, how would you deploy blockchain, Mohammed? It would be awesome. right? So they're curious and they're keeping an eye on the market, and almost all investors will take a meeting with you. But if you don't qualify them in advance, and to Zane's point yesterday, if you don't ask them for feedback, then you'll walk away going, that was a good pitch, that went really well, but they're probably not going to write you a check. So just know that's the mechanics. Okay. From a process perspective, this is an enterprise sales process, right? So you're looking at broad funnel at the top, as many names as you can get to. You're creating. I'm going to walk you through the mechanics of the process. So you're going to use TechNation out of the UK or Crunchbase out of the US, and there's Magnet will also give you the names of people who are writing checks in the region. If you're not getting the Magnet newsletter yet for you guys, I would suggest that you sign up for that. PitchBook's too expensive at this stage, but Crunchbase, for example, is like $450 a year. But I can go onto Crunchbase, look at the company name, look at their investors, see what the average number of investments that company has made and what their average check is. So it'll show me their average check. It'll show me the number of investments they've made. It'll show me what companies they've invested in, which I can look at then and get to the investor profile. So I can see that they invest in MENA or they don't invest in MENA. So what I'm after with that is really to understand, is this the type of investor who would invest in us, right? So for $450 a year for Crunchbase, probably worth it when you get into the serious part of fundraising at the end of the demo day for Flat6. So AngelList is another way to do it. AngelList tends to be Valley specific for Silicon Valley, but you can also pull names of angel investors who invested in similar companies before. I'll talk a little bit more about forwardable emails here in an upcoming slide, but the idea is I want to create something that I can send to an investor that they can forward to other investors if they're interested. And I'm going to ask for approval, like, would you make an introduction or would you forward this to Salah for me, Mohammed, because you know Salah and I don't, right? So I'll talk more about what goes in the content of that in a minute. But process-wise, think about it as very much an enterprise sales process. So don't think about it as like, oh, I found this one great angel investor. I'm going to nurture that relationship and I'll invest. Like I want to find 25 of them. So as I mentioned yesterday, for my first startup, I pitched 167 VCs. So we were doing something unique. Nobody had ever done it before, right? So I just had to, the proverbial fable, had to kiss a lot of frogs, right? So there's a lot of that work going on. So your target investor profile. So I'm gonna look at then LinkedIn. I'm gonna do email introductions. I'm going to find out if they've invested in this stage and this type of product before in the past, if they like the region, and if they haven't, I'm going to prioritize them based on folks who understand MENA, folks who understand Bahrain, folks who've written checks in my size before, and I'm really going to filter them based on what I can learn about them from a research perspective. If they have board experience, if they want to be on the board, I'm going to ask them if they have board experience, and I'm going to ask them for referrals for the people they've been on the board of, because that's a huge, big difference. So know that that's, sometimes you get people who are looking for a job. So they're investing in your company because they want to join. I would highly discourage you from doing that. Like you want an investor who wants to put money in, but that's their only thing that they want to do. But also, is there value add? Can they help make introductions to other investors? Can they make introductions to customers or partners? So that's your target list. You've used those different tools and you built profiles based on LinkedIn. So first impressions, like avoid typos, have stuff done, don't copy and error. So I'll use a tool like HubSpot that has scripts. I also use a tool that I can do to do snippets, so I don't have to type the same message over and over again. Whatever tool you decide to use, and again, HubSpot it's a great tool because you can see if anybody opened the email or not. You'll get a notification of that. So I would use something like HubSpot. There's a free version where you can have a certain number of snippets recorded. If you want to have a bunch of variations, then you'll have to pay for the version. or there's some other tools I'll recommend here in a minute. So the idea here is I want to do a bunch of copy and paste, and instead of doing one at a time, I want to really front end load the process and get to as many investors as I can. So, but first impressions, make sure that you have that stuff done in advance. It's like doing your monthly update emails. It's just something you're going to do on a regular basis. So don't create each one individually. Even with the book today, I'm doing a bunch of podcasts now. So I have all the snippets of those podcast introductions in one of the tools. I use a tool called Text Expander. So Text Expander allows you to hit some short codes on your keyboard and automatically fill in dear first name. It'll insert Muhammad. Here's my information about the podcast. Are you interested in scheduling this time? Here's my calendar link, right? So I'm trying to make stuff as easy as a copy and paste as possible. But I'll show you a couple of bad examples of what not to do as well. So when you can use an introduction to get in, use the introduction versus a cold intro. Some VCs will take cold meetings. A lot of VCs are dependent on introductions from portfolio companies. So monthly updates. So the tool here I'd recommend is doing MailChimp. We talked about briefly as far as your customer updates. You can do 500 connections for free. I'm going to send you a monthly update. I'm going to send it regularly on the 1st or the 5th of the month. I can tag in MailChimp customers versus investors. So as I get further along, I'm going to end up doing an investor update and an update for customers as well separately. In a simple tags process on MailChimp. So I'm going to do 30-day intervals in that content. I'm going to say, here's what we thought, here's what we learned, here's what we're doing about it, is the basics. You should be able to crank that email out in about 20 minutes if you're making regular progress. If you're not making regular progress, the question is why, right? Is the idea not working? Is it too hard? Do you need to pivot? But if you're not making regular progress, the root question would be, what's going on, right? But it needs to be consistent and regular. It will do the work for you. So I will read people's monthly updates. And when I see them start to get traction and they're starting to get users and they're hitting their numbers, I'm like, well, we should meet, right? Versus if it feels very sporadic and they're not consistent. So the last year that I worked for the smaller venture fund, I looked at 167 deals. So not the early, like, hey, I just reviewed their website. No, I met with 167 founders, reviewed their pitch decks, gave them feedback. We invested in one of those companies because they were super early. Had I stayed there, we probably would have invested in 3 or 4 of them total. But in general, that's just the math at the early stage, is you got to look at a lot of deals because most of them are too early for you as a VC. So, but the math is usually about 3%. So if I have good deal flow, and I'm getting deal flow from folks like Flat6, I know that Flat6 has done a lot of the work before I actually look at your deal, right? So you're real, they've vetted you out, they've done some due diligence, they know something about you. So accelerators are great because I don't have to do all the work of like, is this company real or not, right? So know that that's what you're gonna do for your monthly update. From a pitching perspective, some tools, forwardable email, executive summary, your presentation, which is going to be your 13-slide version versus your 11-slide version. You can use more slides if you have more data and more traction. Like I want to learn more about your slides. Typically, these are going to be hour-long conversations over a conference room table, not stand up in front of a room and do a 5-minute structured pitch. So I'll get your forwardable email next, and then my monthly update. So those are the tools I want to have written down in advance. You're always going to be tweaking them, but the idea here is you want to get them done in advance so that you don't have to recreate them every time. So Alex is called from, was it Techstars New York City? Alex is a friend who runs a new VC fund now. And he wrote a great blog post here that you can find on the link. I'll pull it up and post it as well, just so we have it. Oh, we changed that. That's right. The link is different. Hold on. the original website changed. So I'm going to change, I'll put this into the chat window for you. So his point about the forwardable email is do something that's easy for me to forward and make it easy for me to help you. So one of my former board members did this to me a few years ago, and he sent me a note and said, actually I was doing a podcast with him yesterday. He sent me a note and said, hey, Dave, would you mind making an introduction to Alyssa? She's at this and such venture capital fund. And I'm like, I love Eric. He's awesome. I would do anything for him. And I'm like, of course. Right. So I immediately got an email back that was a 2-paragraph email that said, Dave, thanks for making an introduction to Alyssa. And then new paragraph, Alyssa, my company XYZ does basically the Mad Libs pitch you guys have been doing, and requested a meeting. So for me, all I had to do was hit forward, type in Alyssa's email, include a note that said, hey, Alyssa, love Eric. I think you'll like meeting him. He's working on something interesting. Versus me having to write that email for you and knowing that I would probably be wrong. So my analogy is I could show you a picture of my son, Brandon, when he was 2. He is now 28. It would be true. It just wouldn't be very accurate, right? So you need to do the email for me versus me having to do it for you. So the difference is light lift versus heavy lift. Okay, so use Alex's email. It's in the link there. Here's an example of what not to do. This is an email I got from a classic LinkedIn, right? So, hey, Dave, I run a socially responsible fintech that delivers disruptive lending products and sustainable financial inclusion using AI and mobile technology. Buzzword, buzzword, buzzword. To underserved market segments in the US and Latin America. I would like to connect with you. Thank you, Albert. Right. I have no idea what Albert does. I don't invest in Latin America. He clearly hasn't looked at my profile, right? And this is just a copy and paste spam on LinkedIn. This is not effective use of your time. Like, don't do this. So better to use introductions and stuff that you've actually done the research to know that they're the right people. Executive summary. Executive summaries are hard. So just so you know, so you're gonna build your slide deck in 11 or 13 slides. It'll give you a framework for doing your executive summary. Your executive summary will be 1 to 2 pages. It'll include a chart and a graph with your financial model. So the executive summary only serves the purpose to help you get a meeting, just like your deck only serves the purpose to help you get the next meeting. So the idea here is that you want to take something that can be forwarded. So if I have other investors who I think, oh, they'd be kind of interested in this. I'm not a big fan. There's a tool called DocSend that requires me to put in my email before I can review your doc. I work with a couple of family offices today. If you sent me your DocSend doc, I would not forward it to my family office because the guy who started DocuSign, who's worth hundreds of millions of dollars today, is not going to put in his email to review your document. So I know your document's special, but it's not that special. So just make it a PDF. It'll be easier. Mohammed?
Yes, I think we need to think of this as a CV to get a chance at a job interview.
Yep. Yeah, it's really just going to be the attachment that comes in the email that gives you credibility, that says you've done the work already, right? And like I said, it's hard because getting it down to the most important bullet points of your business is really getting the lead of your story and telling your story is not easy. That's why doing the pitch deck first will be super helpful for you. Okay, so past executive summary, but you're totally right, Mohammed. It's totally the case. Your deck, which we've talked about and you guys are doing right now. So some tools here. I would use a Google Sheet. You don't need to use CRM to start or HubSpot to start. You can do a Google Sheet, put all the lists of names. That list of names is going to have Dave Parker, David DK Parker, Dave's phone number, city, and then a link to his profile on LinkedIn, and then in notes. You can do that all on Google Sheets. You don't have to spend 4 hours configuring HubSpot. So, and you can, it's just not a good use of your time. FreeBusyIO is a tool I use for calendaring. because it allows me to use multiple calendars, because I have a calendar for my merger and acquisition business. I have a calendar for DK Parker. So at one point I had a calendar for the family office. So I want you just to see what's open on my calendar. So FreeBusyIO allowed me to do multiple calendars, where Calendly only allowed me to do one calendar. They're both inexpensive, right? So just know that I'm going to set it up so I can have you click on my calendar, find a time that works for you, and make that work. I will give investors both options, right? I'll send them a note that says, tell me what works for you, and I'll accommodate you as the message, or click on the calendar link below and find a time to schedule, right? But I'm going to defer to their calendar first, or their administrative assistant. Totally the case. That's totally okay. I can use Email Tracker Pro or HubSpot to track who opened my email. So it's a little lurker-ish, right? But it's not so bad because I know that somebody actually opened the email. But again, I'm not going to use DocSend and create docs that can only be reviewed after they put in their email. So if somebody asks me or sends me a note and says, hey, can I send you my pitch deck for review? And then they send me a PDF and I can't comment on it. I'm like, I'm just not going to do it, right? It just takes too much work. Versus if you send me a doc where I can actually add edits, I'll add edits, right? But just know that you be contextually aware of what you're asking people to do. Zoom, obviously, this used to be something you had to talk about. Now it doesn't. Zoom kind of works. And then, there's things like Grammarly and other tools that you can use to do just like check your spelling, check your math, check the, make sure you get all those things checked. They're super cheap, right? So I'm a big tools hack. Like I'm fond of tools for that reason. Okay, so what's going on in the VC in the background? And then we'll head off to break here in about 15 minutes. So what I want you to know is that in the VCs are a funny business. They're partnerships. So the hierarchies range very widely on what's going on at the VC. Some VCs make decisions based on consensus. Some VCs make decisions based on the fact that the managing director makes all the decisions. Some VCs will invest up to $1 million without talking to their partners, depending on the size of the fund. So every venture capital organization makes decisions differently. And it's okay to ask them, how will you make this decision? So typical of what's happening is each of the individual VCs from the fund are outsourcing their own deals. So I gave you the original criteria for my Fast 4 and Slow 6. So as a fund, we would go out and source our own deals. We'd go talk to as many deals as we could. And then we decide which deals we wanted to present at our partner meeting. So typically, I don't know why, but typically partner meetings are Mondays. It's super goofy, which means I get to work Sundays writing investment memos, right? So, but you don't get to come pitch the partner meeting unless you've been pre-screened by one of the partners first. So I've watched you, I've heard your pitch, we've met for coffee, I've watched your progression, and I feel like you guys are ready. I should bring you in front of the partnership. Now, I don't want to look dumb to the partnership, especially if I'm a junior associate at the firm. So I have to be able to repeat your message, and I have to make sure that I don't look dumb there. So I'm going to make sure I coach you in advance. So you're going to get a little coaching before you go in based on who the partner is. There's within the organization, you'll see different titles. There is managing partner and general partner. Managing partner is typically the fund founder. It could be the person who's raised the most money, typically is the case. Sometimes they're the person who's making the decisions. Sometimes it's the group who makes the decision. General partners are people who get carry in the fund, as well as the founding partner or the managing partner. And they typically are at even peer level with the managing partners. So as a partnership, they're all making decisions together. Then you have venture partners who typically get paid some carry in the fund, but are not at the same level as a general partner. So they may have not raised capital for the fund or not. And then at the bottom tier, you'll have scouts and associates. So an associate is typically employed by the firm, where a scout gets economics or gets to participate in the economics of the deals they bring into the fund. So the fund mechanics are super simple. There's a 2.5% annual fee and a 20% carry. So 2 to 2.5%. So if we raise a $100 million fund, then $2 million a year can go to pay the expenses of that fund. That $2 million is paid back before I get my participating carry. So if your company exits for $100 million, I'm going to return the money to the investors to put in first. And then 80% of the profits go to the investors, 20% comes to the fund. And then within the fund, the general partners, managing partners get the most, venture partners get less, scouts get paid on the deals they brought, and associates typically get a small chunk as well as their stipend or their monthly salary. So the reason I give you that background is I want you to know what's going on there, because there's, hey, we just invested in 3 deals. I like your deal, but I know I can't get the partners to invest right now because we just did 3 deals. Am I going to bring you in front of the partnership? Probably not. Is it your deal? No, it has nothing to do with you. It has to do with us, right? So just know that that's what's going on in the background with the actual VC at the time. So also, I have a friend who's an angel investor who's written 87 checks to early stage companies. Gary's the only person I know who's ever written a check from a coffee meeting. Until I talked with Gary about it, and he's a good friend. We see each other practically every week. Until I talked with Gary about it, I thought it was an urban legend, right? People are like, I did a coffee meeting and somebody wrote me a check, and I'm like, that never happens. Like, I never. And Gary's like, yeah, I probably did it like 3 or 4 times, right? And I'm like, okay, so it's not urban legend. It does happen occasionally, but think of this as a process that you're fulfilling in what you do, right? So you're going to educate me as an investor. You're going to stay in touch. You're going to make progress. You're going to give me an update. And then ultimately, you guys are going to ask for a check, right? Hey, Dave, can I get you to invest in my company, right? So ask for the check, ask for the feedback. Process-wise, then we're going to do, and as you later stage, we're in early stage, nobody does much due diligence other than, are you incorporated, right? Do you have assignment agreements? There's super light touch due diligence. Later stage, the due diligence goes up, right? Earlier stage, you're going to do due diligence as well. Like, is Dave a good investor? Can I talk to some people in your portfolio, right? If Dave's going to be on the board, can I talk to some of the companies you've been on the board of? So the due diligence process goes up as you get more mature in the process because you're raising more money. Your due diligence, ask for the last 3 CEOs they invested in, ask for referrals. You're like, wow, that's pretty aggressive. Not really. I mean, I'm going to be with you for 7 to 10 years. So we should like each other because we're going to be around each other a long time. A few tactics for dealing with the VCs. You want to create momentum without a false momentum, right? So you can create a reason to close, create a reason to meet with him, create opportunity to say, hey, we're trying to close by this particular date, but don't pick fictitious or weird dates. Like I had one deal that I had sourced the deal through an event that I run called so Angels Pitches and Beer. So it basically is a community event. Anybody can come pitch. It's super light filtering on the front end. So sometimes we get some wacky stuff, but sometimes you find a really interesting deal. So we found the deal that was super interesting. One of the bigger VCs in town took the lead role on the investment. We were going to follow on because we liked the lead investor. We liked the deal. And then they got their term sheet and they decided that they were going to, our Thanksgiving holiday is always on a Thursday. They decided they wanted to close the Friday after the Thanksgiving holiday in like 10 days. And I'm like, we're out. And he's like, well, why are you out? And I'm like, well, I can tell you from our fund's perspective, if it feels like you're holding a gun to our head, we're out. Like our team just doesn't respond to that well, which is, by the way, is true with every fund I've ever worked for, right? And if you're going to index on getting fast money around a holiday versus getting smart money and who the investors are, we're out. So we ended up passing on the deal, right? I like the deal. I like the founder, but it's just like a super weird thing to, it's like he was trying to close for a particular reason. I don't know why. But it ended up feeling kind of weird. So good reasons to close versus good reasons to wait. So if you tell me you have a super big deal on the horizon that's 30 days away, I'm so going to wait because you've given me a reason to wait and see that deal got closed. So don't do that. like give me a reason to close. All right. And if you know you have a big deal on the horizon and it's going to be 60 days out, if you bring it up, I'm probably going to ask to wait and see that that deal gets closed, because it's de-risking my investment. Now, will the price go up of your round? Maybe, but I'm willing to take the risk that the price isn't going to go up as fast as the de-risking happens with a new deal. So that's going to be the way I'm going to look at it from an investor perspective. So yeah, last bullet point's the case. Not all VCs are arrogant and horrible, but some are. Particularly for you women who are out raising money. It's a bunch of old boy club, and it is what it is. It's changing. That doesn't make it right, but just know you're going to put up with, you'll have this really weird feedback loop where one VC will tell you, it's like whipsaw, right? Or whiplash, right? It's like one VC told you one thing, another VC, and you're like, which feedback do I take? And it's kind of the same as mentor feedback. You'll have that experience in Flat6. Like, Dave told me this, and another mentor told me that. And it's like, you just have to be the filter, right? Which content do you want to take, right? But you're also looking for where you have good chemistry. Like, do I like the VC? Do we get along? Do they add good value? Are they helpful? At the end of the day, the money all spends the same. So as a VC, I'm trying to position myself differently so that when the time arrives for us to look at your deal, you're like, yeah, I've always liked Dave, right? So I want to show him my deal, right? So I kind of count on that as my competitive advantage, because all money spends the same, right? And if you're just looking for money and no value add, I'm like, then I'm not going to be competitive with it, because as a family office, our average check was about $1 million, and our target ownership was 15 to 25%, depending on the stage. So, and we couldn't do PR. Like my fund owner was like, we don't put our name on investments. So it made it really hard to find deal flow, because nobody knew who we were. People in the market knew who I was, but people didn't know what the fund was that I was raising money for, or I was investing money in. So there is money out there like that. Just know that that's pretty rare. So yeah, don't give me a reason to close versus a reason to wait. Some final do's and don'ts before I get to your conclusion. Do keep your eye on the ball when you're fundraising. Like, don't miss your numbers. We often had a joke that the first board meeting following the close was always the most awkward board meeting, right? Because they're like, yeah, and oh, by the way, my lead investor or my lead developer quit. I'm like, why didn't you tell me that during fundraising, right? Or we lost a big account, or right. So we just always expected the first board meeting after the fundraise to have some sort of surprise, but keep your eye on the ball, right? Ship the product, get your customers, don't whiff, right? And I literally had one investment who, they're like, we're going to do $1 million in Q2. And then they did 0. And I'm like, oh, that's just brutal, right? How did you go to 0? And why didn't we know about it before the end of the quarter? Like, if you're going to miss the numbers that badly, you should telegraph that, right? Investors don't like being surprised, just like you don't like being surprised by your team. You need to manage the process. So for example, if you're syndicating a deal, and I'm going to be your lead investor, I'll help you syndicate it. But if I introduce you to other investors and you blow it and your pitch comes off the rails with the other investors, I may look at it and go like, oh, I don't know if I want to do this or not, right? So you need to actively manage the process. Just know that that's part of your job as the CEO. Just like a board, right? The board is not your boss, right? You're the boss. The board is there to help you, but it's not there. And ultimately, it does hire and fire the CEO. But we don't if you have somebody who wants to micromanage you, it's the wrong board member, right? What you're after is, how do they help me, but you run the business. Create optionality with talking with multiple VCs. Don't count on one. So I've seen deals not close, not wire, for all kinds of reasons, right? Let alone pandemics, right? So just know that you always need to create options. Don't be dependent on your one investor, because your price options will go down if you're dependent on one investor. And if again, if there's an elephant in the room, like you're going to miss your numbers or something's going to happen, I want to know about it early rather than later, because I have to explain it to my limited partners. Like, why did I invest in this deal when we knew that a co-founder was leaving? And the answer is, well, we didn't know. In which case, my limited partners are like, how is it you didn't know? That doesn't make any sense. So those are some of your do's. On the don't side, as you start this process and get further along, make sure you're starting the fundraising process early enough that you don't have less than 6 months of capital in the bank. Again, this is not where you are today. I recognize today you're like, I'm going to get through. As founders, we're like, I have 30 days of capital. And then you're like 90 days in, you're like, well, I guess I had 90 days of capital. I just didn't pay myself. Right. So you want to make sure you have enough runway to make it work. Don't hide the ball on bad news. Like if you've got bad news, tell your investors. As founders, I think one of the challenges we face is that we just we'll stick our head in the sand and work harder, and versus asking for help. So back to the mental health challenge, like founders are weird, right? We're outgoing and we recognize we need to go talk to people to raise money. I'm not an extrovert by nature. I'm kind of an ambivert, right? You can put me on stage and I'll do okay, but I'm exhausted afterwards, right? And some of you are like, I love meeting people. And some of you are introverts and you're like, I hate meeting people, right? So you can still do this regardless of your profile, but just know that what you're after is, I want to be completely transparent with investors without being too transparent. So what I mean by that is like, I don't want to become your personal therapist once I become your investor. Now, I end up doing a lot of mentoring for a lot of startups, which means a lot of therapy. And thankfully, I've been through a lot of therapy, so I can bring that to the table. But as an investor, I don't want you to be super needy. It's like a bad first date, right? So I don't want that either. So no, I'm trying to balance those things out. And then don't let investors miss deadlines, right? If they say they're going to wire funds on a particular day, be on them, right? So, and because if something doesn't happen, you just need to know. So some conclusions here before I go to just Q&A. Broad funnel optionality, lots of people on your list, right? Don't like raising capital is an exhausting process. So when you find an investor you think is going to be your lead, you tend to take your foot off the pedal and just hope that's the right one. Don't do that. It's super risky, right? So you need to have the best options for the company. As I mentioned before, we're going to be talking with other investors. So within your guys' community, other people are going to be talking about you. So make sure you're consistent about your price and your terms, and your pitch can vary because you're always out testing the pitch, but don't stray wildly based on the pricing. Like I've heard a number of deals where there a company we didn't invest in that just raised $10 million. I sent it to one of my old partners because I'm no longer with that fund. And I'm like, and we passed on the deal. And like, yeah, we just don't know if this is really going to work. And it was interesting. It basically used the data from commercial real estate to look at residential real estate that was on the fringe of commercial real estate and predict whether it would be purchased to be converted into commercial. And they had a stream of data that they could use for machine learning and AI. Interesting company. So mostly it was taking single family homes and going to multifamily, so that increase in density. And I brought it to the partners, super liked the deal, like the founder. They're like, yeah, we just don't know if it's really going to work great. And then they raised $10 million 3 years later, right? So we miss them too, right, as an investor. So just know that it's all part of you find chemistry with folks that work for you. How you interact with the investor at the early stage will be indicative of how they work with you in the future. So if they're non-responsive and they ghost you, they're probably going to be non-responsive and ghost you in the future. So just know that that's probably going to be part of your relationship. Have you guys ever taken a job with somebody where you're like, yeah, I can see that coming? That's what I mean. So you want to avoid that relationship. In addition to capital, how can they help you? Can they help you with go-to-market? Can they help you find a co-founder? Like Flat6 is particularly good at like helping you find the team members. I don't have a CTO, but I have a developer, but not a lead engineer or somebody who can build product. So helping you with that network is super important. And then helping you be available to kind of know your blind spots as a CEO. Like, hey, you're not great at finance yet. Let's find somebody who can help you work on your financial model, right? And then no, ultimately time kills all deals, right? So if you're talking to me and I like your deal and I'm going to lead your deal, I will pull the deal along. Like you don't have to push me, right? And remind me. If you have to push the investor, the odds are they're not going to lead it, right? If I like the deal, I'm going to pull it, but I'm going to pull it at a pace based on what I think the fund will support, right? Can I sell it to my partners right now? Is this the right timing of the deal? But you shouldn't have to push on your lead investor, and your lead investor is going to be super important. So they're going to help you get the deal done and price the deal and price the terms. So a lot of information on fundraising, but I wanted to give you groundwork for both. Once you get out of this program, or if you don't get into the program, it doesn't mean you should stop working on your idea, but you need to find investors who believe in you and believe in your passion and your dream and vision and want to come along and become an investor with you. And then after the program, you're just going to talk to a different level of investor who does it professionally versus doing it as a hobby. So, Alyssa? Oh, you're on mute still. I can't hear you. Can you hear me too? Oh, there you are. Woohoo.
Sorry, I click unmute and it takes like a minute to actually unmute me. But so what do you think is the best answer to this question when investors say, when do you want to close the deal? Like, what is your ideal amount of time?
So I typically I would look at it as 30 days, 60 days. So if you're early stage of the process with an investor, then the question is, you're going to drive the deadline. You can do what's called a rolling close, or you can do a final close, and a lot will depend on how much money you're asking for. In the early stage with angels, you can do what's called a rolling close. So here's a term sheet, here's a safe, here's a note. They can wire money anytime. So what you want to do is, in that case, is just ask for the order, tell them you'd like to close by the end of the month, and then help them get to whatever due diligence they want to do to get to a close.
Right.
If you're trying to price the round, right, then I'm gonna dictate the terms. So I typically don't want it to go more than 30 or 45 days. I want to do it relatively quickly, get it done, and then get you off to the races to go do what you're going to go do. If I believe in the company. If the jury's out and I don't believe, I'll be squishy on my close date. Right. But early on for the stage you guys are at today, if you're talking with an angel who's writing a $25,000 or $50,000 check, the answer is you're going to ask the question at the end of the meeting is, what other questions can I help you with to help you become an investor in the company? At this stage, we're doing so the difference between a rolling close and an escrow is a rolling close is I can take a check anytime. And escrow says I need to raise a minimum of $500,000 before we break escrow and take that money out of the bank. The reason for that is I don't want to be your first and only check in. Right. So if you need 500,000 and my 50,000 doesn't get you there, I'd rather go into escrow and wait for you to get the 500, right? Than have my 50K be the only check that gets in and then be like, oh, hey, Dave, you invested 50K, but we used it and couldn't raise any more money. Yikes. Right. So that's the difference between rolling close and an escrow close.
Okay. Good to know. Thanks.
Yep. Hassan?
Just have a question. What happens when things don't go your way? For example, let's say you get funding and then your idea doesn't work out, or you just don't get enough funding later on. What happens?
It happens a lot, sadly. As an investor, I may be frustrated if you don't communicate with me about it, but I'm not typically surprised that happens. So in our world as a founder, like my world's crashing in on me, things are going bad, I don't have money to pay the bills, like all those things are bad. So you have a couple different mechanics. One is, and we'll talk about this in the pivot section here at the end of the day today before we go into your guys' session about, look, when should I pivot away and do something different? As a professional investor, my answer is I know that most of my investments are going to fail. So as I mentioned, my top decile, my top 10% will return the fund. My top 35% or my next quartile will give me a return, but that means that 65% of the deals I invest on are gonna fail or become zombie startups. Zombies are the worst, right? Because your momentum isn't growing fast enough that you can go raise more money, and you've taken money from investors, so you have an expectation of giving me a return, and you're not getting paid super well. And so typically that's the zombie startup land, and it's worse than failing, because at least if you fail, you can go work on the next idea, right? And if you communicated with me and you did your best, right, and then the market conditions changed, or all kinds of things, kinds of things can kill the idea. You could still come back to me and say, hey Dave, I know I didn't make money for you in this last one. This is what I'm working on now. Are you interested in meeting with me? And the answer is yeah. Like, I know you learned an incredibly valuable lesson in the last one. If you lose money in the second one, the answer is probably don't call me. But if you lose money in the first one and call me on the second one, I'm probably gonna be like, sure, let's talk, right? Because I believed in you the first time, but there's so many things, there's 1,000 things that can kill an idea, right? And it wasn't just like, oh, you didn't, it was you, right? So that's typically not the case. Typically it's any number of factors, like our big competitor raised more money and turned it into a feature, right? One of the ideas I invested in early was they were basically allowing you to take all of the things that happened in your life and create a timeline and tell the story of your life and family and in pictures and blah, blah, blah. And about 6 months later, Facebook came up with Facebook timeline. And it was like, well, you know what? It was a good idea. It was so good that Facebook didn't know anything about their idea, right? It was just one of those ideas you're like, yeah, totally makes sense. It's Facebook, somebody should have done it. And of course they closed the company. It was like, and we laugh about it now. And the guy's a good friend, right? Did I lose money? Am I happy about losing money? No, I'm not happy about it, but you got to swing for the fences, right? That's the whole nature of what you guys are doing.
Yeah. Okay. Thank you.
Yep. Talal?
My question, Dave, startups at early stage tend to participate in accelerators like this to get funded or under programs. Some of them against some shares, and some of them they just fund you against 0 shares. So let's say if you already get a leader investor now, and later on you participate in programs and you get funded with 0 shares. That fund, how does the company like deal with it? Does it go to the capital or for the company, or
if they get 0 shares, they're not buying equity, or are they?
Yeah, no equity. Yeah.
So
I mean, there are many programs in Saudi Arabia and in the GCC. Does that like support the ecosystem?
Yeah, I mean, some of them fund it with grants that you don't have to worry about whether you pay it or not. I'd be a little skeptical about that, because there's an alignment of incentives that, if you're an early investor in me, I want to return money to you, right, and return capital to you. So, but anytime you can get non-dilutive capital, it's great, right? Because you're like, I've got money to go test out new things. So like one of the things that we did early with my first company is we licensed the technology for the Japanese market. And we took that money as a license fee rather than an investment. So in that way, it was what's called non-dilutive capital, right? I didn't have to sell shares to get it, but it wasn't revenue either. The irony is they sold the company to SoftBank 6 years after I sold the company, because they owned the exclusive for the Japanese market. So any way you can get capital in, whether it's grants, non-dilutive capital, dilutive capital in the form of debt or equity, it's really just about how do I fund the company. As long as there's some weird options in the US these days too, like Kickstarter campaigns that have limitations on how many shareholders you can get. And then those ones are hard, because you have to, if you really go raise big money later, you have to fix them, right? Which is super expensive. But it's early social proof, right? It's those sort of things give you early validation that shows that, oh, this idea is actually going to work and it's going to make money, right? And the question is do I have to clean it up later, which sometimes happens, right?
Thank you.
Yeah, of course. Other questions about fundraising or where you guys are at? Again, you guys are in the go raise 25, 50 at a time, go hit some basic milestones, that are probably 60-day chunks, right? But when you get to the serious fundraising for VC, you're going to use a lot more of these things. So, Nazir?
Yeah, so just a follow up on what Talal said. So if you get a grant and
Mhm.
the money goes into the company, it doesn't affect the shareholding at all.
Correct. Yeah, grants are typically just that. It's a here's some money, go do well, go hire people. You'll have to make sure you understand what their key metrics are from a measurement perspective. Do they want you to hire people? Do they want dollars going into a particular community? Right. So understand if there's strings attached, understands what the strings are. But generally speaking, those sort of government sort of sponsored is really like we have one contest right now where there's these guys do this interesting contest every year. It's in Central Washington. So it's about 4 hours from my house, but it's not in Seattle where the Metro Center is, right? It's 4 hours away in kind of rural, the agricultural area. So that lots of apples, lots of grapes and vineyards. And they're like, if you win the contest, they'll do $250,000 of investment, and they're going to give $50,000 for the team to move to that city. Right. And you can predict what's going to happen, right? The team's going to move there for like 6 months or a year, and then they're going to move back to Seattle. So, and as long as there's no strings attached, the answer is, let me see, I get free office space for 6 months. It's great to be there over the summertime or the wintertime because skiing is close, right? And we're going to move some portion of our team over for 6 months. But if it works, great, and we'll create jobs there. But if it doesn't work, we'll just move people back. So I kind of chuckled when I saw it, but I'm like, right now, so many people in the US are moving, like, because place doesn't matter as much. Like when we go back to work, people are like, I work remote anyway, so does it matter? And they're like, hey, it no longer matters where you are. Like move to Wenatchee, right? Which it's just not a big town, right? But if you want to live in the agricultural area, that's super cool. So make sure you know the strings attached so that you're not surprised by it.
I understand. All right, thank you.
Yep, of course. Abdullah, good morning.
Yes, good morning, Dave. How about you win some competition, some money, some grant, really money from competition? How do you report that?
Yeah, so it doesn't come in as revenue. It just comes in as other
Well,
income.
is my internet bad?
No, your internet's okay. Can you hear me?
Oh, other income. Oh,
Yeah. So yeah,
oh
it
okay.
just
Yeah,
shows
I
up
can
as
hear you. I
other
can hear
income.
you, Dave. Okay, so it comes in as other income. Okay, but then do you tell that to investors that, sometimes this money, let's say you win something like the Google Impact Challenge.
Mhm.
Do you, say that to the investor? You've been
Yeah.
able to raise money because they'll ask, have you raised money before?
Yeah,
You
and the
could
answer
say,
is we've won
you
some
could tell,
contests.
you should say that.
Yeah, because it's validation that somebody like Google thought your idea was super cool,
Oh, okay.
right? And for them, it's
Okay.
good, right? Because if I put in $100,000 or $50,000 and Google puts in $50,000, the value of the company goes up, right? And my equity stake stays the same, right? So technically my investment is worth more money, right? So that's good. So I would definitely tell folks. The problem is those sorts of things are very random, right? It happens once a year. It's going to happen one time only. So you can't predict on them from a forecasting perspective, but it's nice social proof or market validation that your idea is important and it matters, which is super helpful.
Okay. Okay. Thank you. Thank you, Dave.
Yeah, of course. Other questions about fundraising before we take a break?
I do, Dave.
Yeah, go for it.
When does an investment or an offer look shady? And are there any terms that we should be wary of? When does the offer work against the company rather than for? If you have any examples, that would be good.
Yeah. Yeah. So all the failed examples I can give you about fundraising are classic. Great question, by the way. So one of the things, especially in emerging markets that are early in the venture world, like you guys are around the region, less so in Bahrain, but more in the region, is early stage deals that aren't tech venture oriented deals tend to look like real estate deals, right? So it'll be somebody who made money in real estate who's applying their same method as a real estate developer to a software technology company. So those deals are always weird because when they show up at my desk for a more mature investment, I'm like, this is weird. Like they have some sort of weird preference or, right, it looks like a real estate deal, right? so usually what I do if I decide I really like the company and want to invest is I'll try to get to help you fix that deal. Right. But it could be that they have preferences, like they get twice their money out before you take the next round of funding. So there's a whole bunch of quirky terms that you want to avoid. I'll give you a quick rundown of some basic terms so that everybody understands it. So the idea is you have common shares and preferred shares. You as the founders have common shares, right? Which means you get paid last when the company gets acquired. Preferred shares can have all kinds of different preferences. So one is called a participating preferred, which means when the company sells, I get my money back. And then if I owned 35% of the company, I would get 35% of whatever was left after I got my money back. Versus a standard preferred just says I bought 35% of the company. And when the company sells for $10 million, I get $3.5 million. Now, if I put $2 million in and I have participating preferred, of that $10 million, I get $2 million first, and then I get 35% of the $8 million left. And you can see how that dramatically impacts what you get as a founder, right? So one of the terms that I like to include early in a deal is pro rata participation, which means if I put in $50,000 early and I have 2% of the company, and you go out and raise more money at a higher price, I can keep my 2% or my pro rata participation, but I have to write a check. So I don't automatically get it, right? I have to write a check for $150,000, but and most angels can't do that, but some funds can do that, right? So I like to give them the pro rata rights because I want to honor the fact that they believed in me early, right? There are also some anti-dilution clauses that says if you don't raise money above a particular price point, then I keep my 20%, 10%, whatever it is. And you have to, which means you guys get diluted as the founders, but my dilution doesn't happen. So there's some terms like that you just have to be aware of. If you use the Series C docs and the safe docs, they're super vanilla, right? They're like right down the middle. They're boring. There's no quirky terms about it. But yeah, I've seen a bunch of quirky terms where I'll come in as a later investor and I'll be like, I need to work with you to fix this or we won't invest. Like they've given you such terms where they get paid before I get paid, or it's just there's those things like that. But if you stick with the open source docs and your attorney knows those documents, then, and Flat6 is really great at helping you with that, because when I come in as an early investor, I'm getting diluted the same rate you get diluted, right? So if you raise the next round of funding and they take 50% of the company and I own 2% of the company, I now own 0.3% of the company, right? Or something crazy. So as an early investor, I'm going to give you feedback around like, I don't like those terms because it's not good for you or for me, right? Because I'm going to come into I'm going to get diluted the same way. So, but yeah, lots of examples of what not to do. It's one of the things is not getting too close to running out of capital, because some predatory investors will look at that and say, like, if I delay my close by 30 days, I'll negotiate a better deal, right? And that doesn't show integrity, but if you're out of money, that's a problem, right? So you always want to have, that's why optionality matters so much, right? And if you get the wrong investor, they're problematic. So keep in mind, as long as you hit your numbers, the investors are going to be generally very, very supportive. If you miss your numbers, right? If you promise me one thing and you miss the numbers completely, I think I mentioned the first day that we had an investment where we invested, they took $10 million. And then the good news was he raised money at a great valuation. The bad news was they hadn't sold anything yet. So he's no longer the CEO of the company. So the board replaced him, because you can only promise great things for so long and not deliver. But it was hard for him because he was the CEO and the founder and he wanted to control the company. But if you miss your numbers, right, the investors are going to look at it and go like, do we replace them or do we give them another shot? They'll only do that for so long, right? Until the investors will get frustrated by it. War stories could go on, but I won't bore you with them. You will create your own war stories, I'm sure.
Okay, thank you.
Any last question before we take a break? All right, so we're gonna take 15 minutes right now. Grab a coffee, refresh, do whatever you need to do. We'll be back in 15, and then we'll talk about your product and company roadmap. All right. So one topic I wanted to talk about real quick before we move on to the product topic is valuation and how you value your company. So one of the questions you'll get asked from Flat6 is they're going to give you a fixed amount of money and they're going to take between 5 and 10% of your company. And I've seen some companies in prior cohorts that thought their valuation should be higher. So I just want to give you some data around how do you figure out your valuation, because there's I think a common misconception with founders that there's this, bound calculation that you can do that will give you a valuation. Valuation at the stage that you guys are at, like Devesh and I were just talking about, if you're just joining back in, was what do you think the company is worth at the pre-revenue stage? And the answer is, it's kind of like a classic car, right? It's worth whatever the buyer will pay for it, right? But classic cars actually have data points where your startup doesn't have, right? So there's no comparables or comps. So my encouragement to you is, it's when you go out to raise money, you're going to raise money at terms that you find agreeable, and you're going to take as much money as you can at those terms, right? The caveat to it is you don't want to take too much money, right? Because with taking more money comes higher expectations. And as Devesh and I were talking about earlier, like the more data you have, the more scrutiny that you get, versus early, if you're pre-revenue, pre-data, then people are like, I believe in you and your dream and like the big market opportunity. But as you get further along in your rounds of funding, then it becomes more about unit economic data, conversion data, growth data, what percentage of revenue, right? And profitability. All those things matter a lot more as you get into your Series A and Series B. So I'm doing a deal right now with a company that they're doing their Series B round of funding. And they were thinking about engaging us to help them sell the company. Their product was fairly niche given their market. So, I was talking with the founders about, like, what do you want to sell for? What's the floor, right? And we thought we could probably sell the company for $35 million, maybe. And then they got a term sheet that gave them a $40 million pre-money value with $20 million of additional investment. And they're like, what do you think of the valuation? I'm like, oh my God, I think the valuation is amazing. Like, you guys take the money, right? It's an amazing deal, because right now there's so much money on the sidelines that there's a lot of money just kind of floating around. Now, does that mean it's easy to fundraise? When we're talking about a company that's already doing $12 million a year in revenue, right? So for them, it's easier because they have the data. For you, the question is what capital do you need to hit the next milestone? And if the terms, will you always get terms you find agreeable? If you're growing and the numbers are going up and to the right, you can set the terms. If you miss your numbers, you don't get to set the terms. If you're pre-revenue, you kind of take terms that you're presented with. Do I think Flat6's numbers are equitable? I think they're in the ballpark, right? Is it a great deal? I don't know if it's a great deal. It depends on what your other options are, right? But a thing that I don't want you to do is don't starve your company because you want 2.5% more equity or less equity than Flat6 will give you. Like, that's kind of a crazy choice. So just know that, like, the valuation discussion always comes down to founders want a formula, and at the stage you're at, there is no formula, right? There's a thing called the Burkus method. So Dave Burkus is a friend and mentor, and Dave wrote the early numbers for, like, okay, so you have a good idea and a good team. Okay, that's plus 250,000 in valuation. That's West Coast numbers, And as I was talking with Devesh before, some of you joined back. If Seattle benchmarks at 100%, the Valley's going to be 180%. New York's going to be 150%. And by what I mean by that is the average seed round in Seattle is $2.8 million. So the average seed round in the Valley would be $5 million. And the average seed round in New York would be $4 million. But the average seed round in your guys' market may be $500,000, which means if I'm an investor who wants to invest in MENA, I find a good deal there. Or you have to go outside of your market to go raise money. But money's transportable, right? For the most part. Sometimes it's hard to get in and out of some countries, but for the most part, it's portable. So just know that you have to go do the work to go. If you want to get a better valuation, you may need to go to a different country to do it, which is okay. Right now, your big question is go hit your milestones, right? And then if you're hitting your milestones, we typically reinvest in CEOs who hit their milestones, right? When you raise your next round of funding, we'll continue to keep our pro rata stake. If you miss your milestones, I probably won't invest. And that's a bad signal to your next investors if your existing investors don't reinvest in the company. And so you just need to know, like, what can I actually go do in the time frame that I have? So on that note, let's talk about how you get to the time frames you want to have around both product and your company roadmap as well. So product wise, some of you don't have an MVP yet. For those of you who do, I'm going to give you a hack that'll help make this easier for you. So if you don't have an MVP, I'm going to give you a process to do it, and as well as link you back to 3 blog posts that'll help you do kind of the step-by-step version of it. But it starts with your product vision. What do you want it to do? How do you want it to change the world? How do you want to change your customers' lives? Focus primarily on the problem, not on the product, right? So because you can pivot around the problem where you can't pivot around the product. So, and a common founder mistake is, you know, I'm working on the product versus like, I really have a really clear understanding of what the problem is the customer is facing that I'm trying to solve, because you may end up solving it a different way. So just know that that's an option. You have to think about what you're going to ship first, what you're going to ship second as your MVP. And as I talked about yesterday, if you struggle with getting lost in your own narrative about your pitch deck, think about what the world is like before your product and what the world is like after your product. So that's the product vision and what you really want to ship out there. And that's kind of the horizon line, right? So when I dial that back, then I have my minimum viable product. So the question there will be, okay, what am I going to ship that goes out of the gate? I'm going to narrow down that features. I'm going to narrow down my ideal customer profile, and I'm going to make sure that it's a product that my ideal customer profile looks at and goes like, this helps me answer this problem, right? I can sell them on the future vision and the sizzle, but not the steak, if you will, right? I can sell them on where it's going as long as I'm shipping new features on a regular basis, right? And I'll get that customer feedback, and that'll help me get the next set of features I want to ship. So early days, you're going to do a PowerPoint version and a demo. I can do wireframes if I have to. I can, you know, I would, at this point in from where I am in my career, if I had an idea I wanted to validate, I would do it in PowerPoint or Keynote first. I would spend $500 on design. I would make it look like a product, and I would show them the product as a wireframe, but as a well-designed wireframe that looks final. And before I actually build anything. So that would be one of the things I would do. And then I'd have the customers rank the features and tell me what features they want to have first, et cetera. So that's going to give you your priority around your build. So, and then keep doing more customer development interviews, because the faster you do the customer development interviews, the faster you'll ship the product the customer actually wants versus the product you think the customer wants. So that's going to be your MVP outcome. And I'll talk about writing a spec here in a minute. And then your roadmap then becomes, okay, at scale, what does it look like? And for founders, we tend to think about the world as if our product's at scale today, right? Which can be super costly, because you know which features you want to ship. And when you go and talk to customers, you kind of, I don't know if you guys probably never do it, it's probably just me, but I end up blending what I think is going to be the future of the product with what the product is today. And to me, they're all the same, right? I can't kind of separate them out. But with my customers, I'm going to ship this like super small version first before I get to the scale version. So just know that as you talk to customers, distinguish what future products are from what the product roadmap is today. And then I'm going to be gated by how much budget I have to spend and how many developers I can buy, right, with the budget I have to spend, which will limit how long it takes me to build out the features. So if I'm building something that's a super enterprise product, right, or a super secure product that requires a CISO suite and compliance and registration, it's going to take me longer to build it, just because it's more complex as a product. So back to my architecture slide in day one or yesterday. So how do you figure out what the cost to build is? So here's a hack that will help you. If you haven't built your MVP yet, if you've built your MVP, this may support you in future features, but it's really designed for the folks who haven't built their MVP yet. So you're going to write a specification. A specification is actually pretty simple. In the doc, in the links in the following slide, there's actually a link to how to write a specification. And I use an example there of a product that is a mobile app product, right? But the idea with the specification is I can hand this document to 3 different teams of developers and have them give me a price to build this first feature set. And I'm going to probably chunk up the feature sets first so I get it into my 2-week sprints. But I'm going to write the specification, and the specification is going to be based on the workflow, right? So I've written my MVP. I've told you what features I want. I've done this, the PowerPoint version or the Keynote version. And I'm going to, into the specification, I'm going to add, like, when I hit the next button, you know, the system or the mobile app will go query an API from Google Maps and return a Google map. So I'm going to write it out as a workflow. Right? You don't need to know necessarily the technology or how the API works. You just need to know that when I hit this button, it does this thing, right? So that specification, and the specification is going to be what's required for your launch, not everything you desire for the product, but what's required for the launch version of the product. Then you can post that project on Fiverr or Upwork. So the mechanic here is I have a specification. It's chunked down into probably 2-week sprints. So it's something that can be done in 4 weeks. And I can actually post that job and get feedback on how much they would charge to build that product. So in the case of Upwork, you can post a job and multiple people can see it. In the case of Fiverr, you have to post the job to individuals, send them the specification, and ask them to give you feedback on it. I'm then going to test my design and my workflows as I get that feedback from the developer, and they can actually give me a price to build my initial MVP features. Now, keep in mind, for your MVP, you probably don't need things like, I need a registration page, or I need an Auth0 page, or I need a checkout page. That's not the functionality. Like, you can build that functionality later. The question is around your core functionality. What is it you're trying to prove with the product? And then use that feedback from the posting to revise the pitch or revise your specification. So yeah, go ahead for the question.
So Fiverr would connect you to a subject matter expert, or really the end client who's going to look at this and say, this is how it's going to work, and this is how it's not going to work.
Fiverr or Upwork will connect you to a developer or developer teams that can give you a budget to build this to the specification. But if you don't do the specification, they don't know what you're building. They can't give you a budget. So the specification is required to get them to give you a price to build it. Make sense?
Okay, got it. Yeah,
yep.
Thanks.
Samir?
Hi. So we can reach out to developers and talents on Upwork to hire them to do our job for us. But my question to you is, since we're in a tech industry, how do you make sure, because there's a code and I don't know, maybe IP, how do you make sure that your rights as the owner of the idea or the company are still preserved in that way?
I love it when people ask questions and I can go, perfect question, next slide. So in these 4 blog posts, here's what I've outlined for you to go in, because I don't want to go into detail with this one today, because it's super granular and it's very step-by-step. So blog 1 is about writing or launching a product. Blog 2 is about writing a spec. Blog 3 is about picking a vendor. And blog 4 is about contracts and managing the process. So let me give you the hack that I've used in doing this. So I write the specification, I get some initial feedback from developers. I've refined the specification to get my minimum like 2-week sprints. I'm not trying to buy the whole product, and I'm not trying to hire a developer for the next year, right? I'm trying to find somebody who can give me 2-week sprints to get me an MVP that I can go show customers. So the cheapest I've ever done this is about $600, and I've spent $6,000. So somewhere in that range to just get an MVP built. The process I'm going to use is, in addition to the 4 steps, I'm going to take that specification, I'm going to post that job on Upwork. I'm going to look for 3 teams or 3 developers, and I'm going to pay them $50 each to sit into a 1-hour meeting. Here's the objective of the 1-hour meeting. I'm going to send you the specification. I'm going to ask you to write your questions up in the Google Doc as comments. I'm going to have you sit in on the meeting and take meeting minutes. So what I'm looking for is, did they review the document in advance? Did they ask good questions about the document? All the questions they ask get shared with all three of the development teams or all three of the developers. They're going to ask more questions during that conference call. I'm not asking them to build anything yet. I'm telling them, of the people who apply, I'm going to choose 3 developers or 3 teams, and I'm going to pay them $50 to sit in on the conference call. So that's the first deliverable, just the conference call. I'm going to pay them to do that. They get paid out of the escrow when they give me back the meeting minutes, they summarize the comments from the meeting minutes, and they give me a budget for the project. Then all of them get paid their $50. Then I'm going to choose from that list of 3 or 4 attendees, 1 or 2, depending on what budget I have. My preference is 2, to build me the first 2-week sprint based on the budget they provide. Why 2? One of them will likely fail. I just don't know which one. So if I don't hire 2, then I have to do it sequentially, versus if I do it concurrently, one of them will work, one of them won't. Now, I could waste $500 or $1,000. Yes. And I could delay it another 6 weeks. So I would rather pick 2, pay for 2. But again, I'm only paying for the first 2-week sprint. I'm not paying for the entire MVP, right? Which is why it's important to chunk up the specification into 2-week sprints. They're deliverable then at the end of 2 weeks. That money goes into escrow with Upwork. If they hit the deliverable, so I've given them a spec, they've given me a price, they've given me a budget, they've asked questions about it, they've given me back meeting minutes, so I know if are they going to be a good project manager or not? Can I communicate with them? If they speak a different language or in their different time zone, is that going to be okay? And the meeting minutes kind of helps me pick who the right partner is. Right. So now I pick 2, one of them works, one of them doesn't. I get through my first 2-week sprint. They give me a budget for the next 2-week sprint. I'm now 4 weeks in. Maybe I spent $2,000 or $4,000, but I have an MVP.
I love your idea, Dave.
What's that?
I love your idea, because I was stuck with one freelancer 3 years ago. I wanted someone to create the layout for a book. And unfortunately, I didn't meet you by that time.
Yeah, well, I've done this wrong a bunch of times. So I figured out that, like, if I hire 2 of them, my odds of success go way up. So yeah, so it definitely works. It's a good hack. It's not as good as having your own CTO, right? So, and one quick note about this is you're gonna throw this away, right? So, you know, is it built on Ruby on Rails? Is it built in JavaScript? Is it built on no code? The answer is, at this phase, I don't really care. Like, ideally, I'd love to predict that, but that's a secondary consideration that will slow me down. If you're new to the no code world and all the changes that are happening in no code, I would point you to Airtable and Bubble, because there's a whole bunch of things that you can build and do rapid prototyping in that don't require you to be a coder. Now, there's still a ramp rate to understand the tools and tech. I'm super excited about it because I'm just geeky enough that I can code, but I'm not fast, right? So I'd rather hire somebody who's fast, because I can crank out a specification. So if you go to this blog post too, it'll show you how to write a specification. So I've taken away your excuse of like, well, I can't find a developer. In the time some of you will take trying to find a developer, you could learn to become a developer. Like, some of you will be like, a year from now, I'll be like, yeah, you still working on the same idea? Yeah, I'm still looking for a CTO. I'm like, oh my God, learn no code, right? Go take a coding course. So again, I'm not fast at it. And my friends who are real developers are like, Dave, you're not a developer, you're a hack, which is true, right? But at least I can hack something together over a weekend and either prove it out or not prove it out. So the point of this MVP is I can do it relatively cheap. I have a team. If it works out, I can keep using that team. If it doesn't work out, I pivot and use a new team, right? But I'm going to do the same process again: specification, do the meeting, look for the meeting minutes, choose 1 or 2 vendors based on my budget, and then get my first 2-week sprints in to get my MVP back. Go ahead with your question.
Yeah, my question is basically, what would be the difference between a prototype and an MVP? Because
They're
we
the same
have a
thing.
prototype, so the MVP is a minimum viable product, but it's not like the one which can be dropped in the market, right?
Yeah, so I tend to think of a prototype as maybe it's working, maybe it's not, right? Maybe it calls the APIs, maybe it doesn't. Where I think of an MVP is like, if I wanted to actually go sell it versus just show it, my MVP is actually something that can hand Devesh and he could actually use it, right? It may be clunky and it may not be everything he wants it to be, but it's something that's like, I can go get feedback on, where I think of prototypes as kind of a step past a PowerPoint version, right? Where it's like,
Okay.
I can show it to you, but you can't really use it. So
Like a proof of concept?
yeah. So proof of concept is something you're typically building as a one-off for a customer. So where somebody says, hey, I like your idea, but I don't know if it's going to work for us. We'll pay you to build a custom version or modify the workflow. And we'll pay you to build that as a proof of concept. So POCs can be paid or unpaid. But the idea of a POC is, think of it like it is as an extended trial that typically is B2B, right? So a big company, for example, sees a risk in going to a startup and having them build something because they may not be around in 6 months. So I don't want to change my workflow to accommodate a startup because, gosh, if you guys aren't around and I've changed my workflow and now I have to retrain people and do all that kind of stuff. So a POC is a way for me to see if it works for us, pay you to do the work, and actually prove it out, right? So those are all variations of the same thing. It's all about de-risking for the customer, especially in B2B.
Okay.
Where with B2C, I may be buying an app, a tool, something I can order travel on or something like that. Those are all interesting ways of being like, I have to do an MVP because I don't want to support one customer if I'm not getting paid for it, right?
Great. Secondly, if I'm a developer, so should I work on it myself or should I go and hire someone? Because yeah, as a CEO, you need to have multiple hats on, right?
Yeah. Yeah, it's a great question. It really comes down to, given all of the things you need to go do, you may have as a developer like, oh, we're going to do it in Python, right? Or we're going to do it in JavaScript, or we're going to do it. You may have a confirmation or a selection of like, well, I know what I'm going to build it in architecture wise. And in your case, you may look at it and say, I'm going to outsource this phase and I may throw it away, but hopefully I can manage them in such a way that I don't have to throw it away. Right. So
Okay, yeah.
it's really just a question of, if you think about, I have limited cash and a bunch of stuff I have to do. If I have to do everything, then you're going to be gated on other things where I would look at it and go, you know, how do I build out a team? Because you're going to have to learn this sales skills and marketing skills because there's only so much you can afford to buy. Right.
True. Okay. So it's better than making a part of it for yourself, like architecture, and get someone to do the coding and stuff.
Yeah, again, it depends on the complexity. Ultimately, the company is going to be valued on having a technology team. Like investors want you to have your own developers and your own tech team because it's intellectual property. But if you're just straight MVP, or I would say in a parallel world, you're like, we have like we were talking about pivoting earlier with like, should I do this or should I do that? You may look at it as a developer and say, well, I can build one of them or the other, but I want to outsource the other one. Right. So, or I have a new feature I want to test. I want to build the MVP for the new feature and have the offshore team do that work for me.
Great. Yeah, that works great. Thanks.
Yep. Sir?
Yes, just to follow up on the hiring a dev team, especially on Upwork with the freelancers. Should we make them sign NDAs? Should we ask them to send over the code, deliverable?
Yeah, so what you'll see in contracts monitoring progress in blog 4 there, Samir, is you'll have a information assignment agreement. You'll have a contract. The contract will have the deliverables. It's also, you know, you're going to do weekly stand-ups. So it basically outlines for you all the steps in the process of how you monitor it. So with Upwork, you have to put the money into escrow before you start the project. And then as soon as they hit the deliverables, you approve the deliverables and they get paid. So the big thing is the specification has to nail the deliverables because, I mean, you know, because you're in the dev world, right? But for the folks who are new to it, if the specification is fuzzy, you're going to get a fuzzy product, right? So the specification has to be very crisp. But you own the code. It gets posted in GitHub in a private repository, right? So the idea is you own all of that. It's in GitHub. You get it, and the code gets posted to Git before you release the dollars in payment. Right? So you have control of all of the assets. So could somebody copy you? there's always a risk of that. It seldom happens. More ideas die from lack of exposure than from overexposure. But there's always a risk that, oh, could somebody copy my idea? Yeah, there's always that risk. Do they know the market the way you know the market? Probably not, right? So you just have to look at it and go like, is that worthwhile or not? Most of the developers you're going to talk to on places like Upwork really want you to give them more work over time, right? That's their motivation. I would not take it off the platform, however. Like you can, once you know a development team, they'll be like, hey, we can just bill you direct, right? Versus doing it in escrow. Until you have a relationship established, I would not do that, right? Because they're going to be like, and then the next time they're going to ask you like, hey, we need to hire another developer. Would you mind paying us in advance? And the answer is, oh, absolutely not. So I like it going in escrow. They know they're going to get paid, and I know they're going to deliver the deliverables into Git before I actually pay them. But there's each of these blog posts gives you kind of step by step for each of the sides of the process.
Okay, great. Thank you.
Yep, of course.
Dave?
Yeah,
I have a question.
I just saw a hand up first. Oh, he put his hand down. Never mind. Go ahead.
Yeah, sorry.
That's okay. Emma, go ahead.
Okay. So my question is around B2B companies. It's really hard to have people test in B2B. So you have to ship out a product in production for users in B2B to actually use it. And my question is around how do we get the right users and the right demographic to test an MVP in B2B as fast as possible? Because the way we're working right now, we try to do sprints, but who's going to use the product at the end of the week for us to test it? So how far are we going to build something before actually having the right customer or user demographic to test it?
Yeah, so as you break down this spec, what you're trying to get to in this phase of testing out an outsource partner, you're really trying to prove that they can deliver to a specification on a regular schedule. So slightly different process than you're asking about. So if I have a dev team internally and we're building product already, then I'm looking at it going, okay, what are the feature sets I need to launch in order to get the customer engaged and use the product? So two slightly different questions. If I'm trying to find a team who can help me do it, the sprints matter because I want to have them show me they can deliver. That's not about the customer. It's about me learning how to work with them. In the customer side of it, it says I have to, my number of sprints may be 6, right? It may take me 12 weeks to get a really minimum viable product before the customer actually sees something they like. So what I'll do in that case is I'll go out and talk to multiple customers who could be my ideal customer profile. I'll show them the Keynote version or the PowerPoint version, and then I'll ask the customer development questions, and I'll keep doing that as the sprint is going.
Okay.
Right. So I'm always doing customer development to validate, like, these are the features you want. Okay. Now I'm going to change a sprint in the third sprint. And we'll be like, oh, we decided we want this feature before we want that feature because the customer development. And then when I have that feature I can ship and I really have an MVP they can use, I'll come back out to that same group and say, you asked for this, here's this version. Is that what you wanted? Right. And it may not have the wrapper and the graphics around it. It may not have a registration page or a shopping checkout page.
Yeah.
I'm really just testing that core functionality, and I'll walk them through it as a demo and go, so you said you wanted this, here's how it works. I click on this button, it goes to this, it pulls this API, right? Whatever the features are. Is that what you want? And they'll be like, oh yeah, that kind of works. But it would be useful if we had this thing, because we in our workflow today, we have to go check this thing first. And you're like, oh, okay, how do I do that? Right. So it's part of that iteration process, but your build cycle and your customer interaction cycle are two parallel processes.
Okay. That's all. Thanks.
Yeah, of course. Other questions about product before we move on to company roadmap? Okay, so let me put this in context for you for if I was your board member, right? To help you understand, like, what am I trying to do from a company roadmap? So the company roadmap is both product, revenue, people, right? So you're going to set these as quarterly targets, because monthly implies a level of precision you just don't have yet, right? So it may take you 3 months to build your MVP instead of 2 sprints in 4 weeks. Great. right? Whatever it takes is what it's going to take. So setting quarterly objectives is the thing that I'm after. Your broad categories are product. What are the milestones for product? People, like what are I need to hire an offshore dev team to build my MVP, great. Or I need a VP of sales, or I probably need a salesperson first before I get a strategy person. How many customers am I going to onboard? How many customer development interviews am I going to do? How much revenue do I expect and when? And what's my cash out date, right? Because I always look at it and go like, okay, when are you out of business? Because that out of business date will help you prioritize what things you have to ship first, right? So those are the broad categories. Your roadmap should not be dependent on funding, right? You should be able to look at this and say, with or without this next round of funding, this is what we're going to ship next quarter or the following quarter. And then if we get funding, we'll move this thing up. That's 4 quarters out. We'll move it up to 2 quarters out. So the concept here is that when you start raising money, you're going to come talk to me and say, hey, Dave, we're going to do $1 million in revenue next year. I'm like, wow, that's amazing. You're going to go from 0 to $1 million. Like, so when I think of the early stage startup, 0 to 1 is super hard. 1 to 10 is super hard in a completely different way. 10 to 100 is super hard in a completely different way, right? So each of those steps have a different set of things you have to go execute on to actually make it work. But 0 to 1 is a difficult stage, right? So what I want to see is that you're going to go out and make continuing progress with or without my check as a VC, right? And then when you talk to me every month, 2 months in, I'm like, oh, you nailed your MVP, you've got it out, you have some initial users, customers are excited about what you're doing. I'm like, ooh, these guys are doing awesome. Like they're gonna go hit it with or without me, right? Now I'm super interested to get engaged and help become part of your team. If you present me with a plan that basically says, hey, until I raise $1 million, I can't do any of this stuff, then you're going to be in the 90% of companies I see. Remember I referenced 167 companies? 90% of those companies were like, if we get the money, we'll go do this thing. And I'm like, chicken and egg, right? You have to prove that you can go do some of the things first, and then I'll join your team and get excited about it. If you're totally dependent on the money first, I won't join your team. I'll wait for you to figure it out, right? Because that's the way you're going to do it. Now, the top 10% basically went out and did it with or without me. I'm super interested in that top 10%. The top 1 or 2% not only went out and did it with or without me, but they're exceeding their numbers and expectations. Like their revenue's climbing faster than they thought, right? They told me they were going to have 10 customers and they have 15 customers, right? You want to get an appointment with a VC, they will call you before you call them, because we said we're going to be here, we're actually here, right? I'm like, wow, you are in the rare air. Like I love teams like that because you figured out a way to make it work. So your roadmap is not dependent on the cash. You put those things further out in the future. It should map to 18 to 36 months, right? 18 months being the practical number, again, as you raise for more VC. It should map to your financial model, like the pieces come together between this piece and your financial model. And then it maps to your use of proceeds, right? So when you say, hey, we need to raise this money, we're gonna go hire these people. So on the back end of that, it should say, here's in this 3 quarters out, we're gonna hire this people and this team and hire a person to run sales, et cetera. So what that looks like, and this doc is actually, if you just click on the graphic here, it'll take you to the blog post that has this content. This doc, basically you'll see here, I've got my quarterly milestones. I'm gonna click over and open the window and I'll pull the interactive version over. Again, my only request here is you guys make your own copy versus putting your data into my copy. So, all right. So can you see my Google Sheet now? So that same blog post, by the way, will have both the Google Sheet and an Excel version as well. So what we do here is I hide the quarter that's already happened, right? So the quarters that have previously happened, if I'm a board member, right? Every quarter we have things that we're doing. I'm just hiding the quarter as I go. So I have a history of the things that we've done. So you'll see that every category has an owner. You can't own everything. Well, technically you do own everything, but you need to distribute that between you and your co-founders. So customer acquisition, ownership, Who's going to do what? How are you going to do it? If trade shows are your thing, how many trade shows are you going to do this quarter? If Google ad spend is your thing, how much are you going to spend on Google ads this quarter? So I'm trying to break this down into logical parts so you know how to prioritize your time and actually execute on the tasks. So you'll see here too, I have a priority and an impact. So my priority is A, B's, and C's. I don't know about you guys in your task list. With my book coming out, my task list is crazy long. So I basically prioritize those tasks into, these are my A tasks, I got to get done first. These are my B tasks. These are my C tasks. If I get to them, that'd be great. But I'm also looking at impact, right? Is it high, medium, and low? Like fixing bugs. I know I need to do it, and I'm accruing technology debt or tech debt as I go. But at this point, I don't have product market fit. So if I don't get product market fit, the answer is it's all tech debt. So do I want to fix it? Yeah, I want to fix it, but it's probably going to take me some time to fix it. So first category is marketing, customer acquisition. Who owns it? Is it you? Is it your co-founder? What's my marketing budget by quarter? How many leads do I expect to come in this quarter? So these are basically my key metrics for marketing are in that first section. Sales, who owns it? How many reps do I have? How many sales am I going to make? And then what are my key metrics around sales? Right now, you guys don't know the metrics for each of these, and it's okay, right? Just know that this is where you're going to get to report to your VC or to report to your board. But it'll help keep you at a level up out of the details to say, am I hitting these things or not? Revenue. So these two then come into this category of actually the revenue you expect to have. Who owns revenue, right? Again, it's going to be you for now, unless it's your co-founder. I'm going to ask questions of things like billing. How long is it taking me to get paid? So whatever your key metrics are around revenue, I want to know that as a board member. So we have a big accounts receivable from a big customer that represents 80% of our sales for the quarter. Okay, well, how likely do you think it is you're going to get paid? Or are they going to pay on terms if they're behind, right? With COVID, we saw both sides of that extreme. So revenue there. That gets me into my quarterly revenue. How much revenue do I expect to do this quarter? Again, this is just going to go quarter to quarter. I just want you to have, in the early days, you'll be wrong, but I still want you to have a goal, right? Because you're like, oh, our goal was $100,000, but we came in at $40,000. Okay. So the thing that I'm trying to encourage you to build is build muscle in your forecasting, right? Are you getting better at it every quarter? All right. So then I get down to product. What are my major releases? What are my feature upgrades? These are my basic blocking and tackling components of my product. The next one is people. So what are my critical hires? So, and again, when I think about a board level, it's like, I want to hire a CTO. I want to hire a VP of sales. Great. We're going to bring on 2 new salespeople this quarter. Great. Right. What I'm generally looking for as a board member are we tracking to the things you said you were going to do? Because I don't want to go back and look at the board meeting minutes to figure it out. I want to basically look at this and say, hey, when you think about your spreadsheet that we talked about the other day, and we think about hiring, how many people do you expect to hire this quarter, next quarter, or do you need to go find a co-founder, right? Those are, it's not, don't be overly precise. It's like, I think we're going to need 2 more developers in Q4. Okay. So if that's the case, when do we need to start recruiting? Probably middle of Q3, right? Okay, to do that, we need to have budget and money in the bank of this amount of money. Okay, so you're basically building a build back plan based on what your goals are. Instead of like, hey, we'll get to it as soon as we raise the money, we'll get to it. I want you to be like, this is our plan, we're doing a build back plan. That it'll work better for you to help planning. Next category is ops and finance. So if we're doing services delivery, if we have taxes that are due, if we have to file with the state, if we have to do, whatever our legal obligations are, somebody needs to own it. You can outsource this to a part-time CFO, right? If you have the money to do it. And the last one is the category, because most of you are idea generators. So the last one is important things we're not doing yet, or as my friend called it, ITINDY, right? So my ITINDY list is like, oh, that's a really great idea. But I've already tasked the team and my co-founder with doing this thing, And if I task them with something else, they're going to ask me the question of like, what do you want to delay? Because I only have so many hours in the day and I can't do everything that you, the idea person, wants me to do. So you want to capture those ideas, but you want to put them into a realistic schedule of when you might get to it, right? Especially if you're making a pivot, right? Or a board member comes up with a great idea, right? You're like, I want to capture all those ideas, but I need to put them into quarter that's realistic, right? And then I need to let my team focus on stuff. So, because I was notorious at one point, my team, we were 150 people, and my development team gave me my own developer, right? And she didn't work for the rest of the team. She just worked for me because we were doing prototyping and building new features and doing MVPs but my engineering team probably had 35 people at the time. And they're like, dude, you are making us crazy. Like every time you talk with an engineer, and the challenging part from a culture standpoint was my early engineers worked with me since the beginning. So they wanted Dave's approval rather than their manager's approval, right? So I was basically creating chaos in the organization. So they're just like, we'll give you your own developer. Just stop asking the team for stuff. It's not working, right? So question there, go ahead.
Question about outsourcing. What would you advise now that almost everything can be outsourced in today's technical world? What would you advise that has to be in-house and can be outsourced?
Yeah, your core functionality needs to ultimately be in-house because it increases your enterprise value. So I'll view that as like a company that is doing well but has an outsourced development team. The amount of money you will raise will be half of what you could raise if you had the core team in-house. Because I view that as an asset and I'm investing in that asset. At the same time, if you can launch your prototypes and MVP while you're recruiting a CTO, just recognize that CTO may want to rebuild everything and probably should, right? Because they didn't, ultimately, this isn't necessarily built in a scalable way. But to your point, I can get a lot of stuff done on Fiverr or Upwork that I don't have to have a deep relationship with. And honestly, I don't have to give away a lot of equity to a co-founder on to prove a prototype. So if I can do that, so I'm in a funny place in my career. I have lots of ideas. Every once in a while, I'm like, oh, this is a really good idea, but it's probably not a big business. It's probably a $10 million business. So do I want to go raise money on that? No. Do I want to build a prototype and see if it works? Oh yeah, that'd be fun. Right? But I have the capital to do that, right? Versus some of you are like, well, I don't have the capital to do that. I need to find a co-founder. Totally, right? It's driven by those factors, right? At the same time, I could launch a new product company, build a small business, never give any equity to anybody and own 100% of it. But that one's probably a small business, right? If it was truly a big idea, I'd still want to build a core team because that's part of the asset of the company. Right. And that intellectual property and tribal knowledge is super, super important. So just know that that's definitely a driver from the investor perspective. Early stage, you can get away with it. So you'll see down at the very bottom, you'll see end of quarter cash and what's called burn rate, which is the number of months I have left before I run out of cash. Now, for all of you, the answer is that's tomorrow, or it could be next week, or it could be next month. That's the reality of the stage you're at. Right? So don't stress about it, but once you start hiring people and you have payroll to pay, right? And it's not co-founders who are working for equity, then number of months till you're out of cash is super important. And what I'm after is like 6 months to out of cash, 3 months to, I just want to know what it is, right? As a board member. So my end of quarter cash and final burn rate. So make a copy of this or download the copy from the Excel spreadsheet. But use this as kind of your quarterly planning. This will help as your input to your financial model as well. Because the question of like, well, I'd like to have 5 engineers. Wouldn't we all? How much cash do you have? Right? And the cash is going to dictate when those things are available. And you may say every quarter, we're going to hire a new engineer. Great. Right? But I found for me personally, I do better when I set goals for myself rather than I haphazardly say, I'm just going to work this as fast as I can. I would challenge you, set the goals first and build your work plan to do it. Will work a little bit better for you. All right, let me swap back around to different screen here. Okay, so feel free to use that, download it. I think the key highlights here is what you're gonna create for your slide here is basically a quarterly milestone of your time in the program. So think of it as this. So far we have done these things going backwards, right? Is going to be your slide. During the program, we hope to achieve these things, right? We're gonna find initial traction in customers. We're gonna test our marketing. We're gonna find a CTO, like whatever your core things are, you're gonna do in the 90 to 120 days of the program. Outline those in the program, because again, to get into the program from a contest perspective is I'm competing with the other people on the call. Do I have clear idea of what I want to achieve while I'm in the Flat6 program? Great. If you're fuzzy about that, the selection committee is going to go, I don't think they know what they want to achieve yet, right? And the teams that have clarity about what they want to achieve are going to get in, where the teams that are squishy about it are going to be less likely to get in, to be super candid, right? So we want to get an MVP launched, right? We want to get initial customers. We want to test our pricing. Whatever your goals are during the program, that should be your program goals. Post-program, right? We're going to go raise this amount of money. We're going to get to market and launch. We're going to go from our MVP to our first launch and scalable product, right? So I'm going to tell the story in that one slide of here's my time frame to date, right? It may be a squiggle chart that says we started here, we incorporated, we're here right now, we get into the program, we're going to test these things, we come out of the program, we're going to test those things. That's all I'm after for that slide. But it will help the selection committee compare you to the other teams that are competing to get into the program. Questions about your deliverable on this slide. I've given you a lot of tools that will help you later, but the slide has to be pretty crisp about what you're going to deliver. Don't go into this, the slide or the spreadsheet I showed you, do not give that level of eye chart detail, right? Pull up to 30,000 feet and tell them what they're going to get if you get into the program. Questions there?
Yeah, so the slide is going to be between our time with Flat6 Labs, or are we going to extend it more to like the 18 months?
We look at it for 18 months. Less time talking about your history, more time talking about your future. So as founders, we tend to tell our founder origin story, right? Which is super important to us, but it doesn't help you get into the program. I mean, a little bit of it's fine, but it's really about what are you going to achieve during the program and what are you going to achieve for the next 18 months, roughly, right? So think about it as your major milestones with a little bit more detail in the 90 to 120 days while you're in the program. Does that help?
Yeah. One last thing. How much history should be involved, or like none of it?
How much should be what?
History, the past in the timeline.
You know, I'm always for a little bit of origin story is good because it gives me context to understand you. But so investors are really about funding your future, not funding your past.
True.
So tell me how you're going to use the $35,000 you're going to get to make a dramatic impact on the business you're planning to do.
Okay, got it.
Okay. Other questions about this particular deliverable? So I hope the tools are useful as you continue to go forward with the business, but again, don't get wrapped. If you give me this eye chart, I will be sad. Like tomorrow when I see your deck, I'm like, I don't want to see an eye chart. I just want to see major milestones, future looking, roughly 18 months, could be 12 months is fine. Okay. If it starts to get too much of an eye chart, do a shorter time frame, right? And if you hopefully it's a good hack if you haven't built your MVP yet and you need to build your MVP. All right, questions before we go into lunch. We're going to take an hour break for lunch, and then we'll come back. We'll go through pivot, when, why, and how, and we'll have some of the folks from previous cohorts to talk about what their experience was with pivoting as well. Questions before we break for lunch? Yeah.
If I may ask a question.
Yeah.
Can you share a story or two about how CEOs did not manage board of directors? I have a few, but I want to hear from you. Basically, how do
We have
you
lots.
break your company with your own hands?
Yeah, I think the biggest thing at the stage you all are at right now is that you really want to get people who really are there to add value, not just add money. So there's a couple things you want to avoid. You want to avoid people with observation rights that, so they can bring a junior associate to train the junior associate. Like when you're more mature, the answer is, okay, fine. But at the stage you're at right now, you're like, I don't want to be distracted with trying to mentor a junior associate, right? So focus on the folks who can help you get the best value and get to market faster. One of the things I'm a huge fan of is independent board members, where you can bring somebody on who is they're not an executive, an employee for your team, but let's say you're weak in marketing, right? And you want to bring on somebody who is a quality VP of marketing person who could come to your board and help you with thought leadership and marketing. So you could hire a more junior talent using them for strategy. My caveat there is, if you're all dudes, I want to make sure there's a woman on your board. If you're all women, I want to make sure there's probably a man on your board. Not because you need a man. I mean, like a fish needs a bike, right? So that's not the point. The point is that diverse and inclusive teams produce better results. I would encourage you to get people who don't look like you, right? Because, and that's one of my things about mentoring. I always want to encourage people, like, mentor people who don't look like you. That's super helpful, right? So, but the statistics are, from a board perspective, diverse and inclusive boards produce better results, just like diverse and inclusive teams do, right? So what I'm after for you there is look for areas where you're like, I can't hire a VP of marketing. Could I bring on a VP of marketing, give them 1.5 or 2% of the company with a vesting schedule, and then have them function as a advisor, super active advisor to the team, where I can hire a marketing person to go execute their strategies. And that may be a salesperson, that may be a technology person, that may be a chief security officer, right? Whatever that gap is in your team, look for that as an independent board member, because it's a cheap way to get somebody thinking about your business. I would tell you, for the most part, I'm a better board member than I am investor, right? My money is the same as anybody else's money, but having me think about your business more is worthwhile. And because I tend to, that's just the way I work, right? I'm always like, have you guys thought about this? Have you thought about, now you have to filter out my ideas because I'm not always current with your thinking, right? And I'm typically only seeing you in a fairly structured way. So I'm not engaged all the time in the business. I'm not a co-founder, right? So look for those folks who can add value and they fill gaps where where you have those gaps. I'm a super fan of, like, I don't want to be the smartest person in the room. If I'm the smartest person in the room, I want to find a different room, right? So you have to be comfortable with finding people who are smarter than you are. And hopefully you can do that, versus like, it'll be a drawback for your business. It'll clearly hurt your business in the long term if you can't do that. So I would definitely look at that as things you want to do.
Thank you, Dave.
Other questions before we break? All right, so when we come back, we're going to do pivots. After the break, coming back from lunch, it's all about your guys' decks. So take the next hour to continue to work on your deck. We'll be back in the top of the hour. So let's call it 65 minutes, because you have more time to work on your deck. And so we'll see you back in about an hour. I'll be logged in about 15 minutes early. So if you have specific questions to you, I try not to do private office hours with this, just because it's a little cumbersome. But if you want to, if you have specific questions, you know how to catch me on WhatsApp. You can, that's probably the easiest. I'll try to answer them as well as I can, but if we're in a session, it's hard for me to focus on your specific question while we're doing that. So make sure you put it in the WhatsApp channel versus the chat window, because as the chat window goes by, I've lost it. And then also come back with your slides. Preference for the folks who have their slides done first. But we're all work in progress as we get through the next couple of days, so not a problem. So I appreciate all you guys' courtesy about, hey, do you mind if I ask a question? That's why I'm here. That's why they've hired me to be here for you. So I'm here about you guys and answering your questions. So I'll be back 15 minutes before to make sure I can answer any specifics to you individuals as well. So go enjoy your lunch break and make it a working lunch and get your slides done. See you in 60 minutes.
Yes, thank you, Dave.
Thanks, Dave.